Alongside Brad Smith, and this is Yahoo
Morning. Stock futures pointing to gains at the open as the market looks to rebound from recent market weakness here. The Dow snapping, though, its 6-day losing streak, and the S&P 500 eyeing a little bit of a comeback here.
The moves here coming as investors digest a higher for longer interest rate mantra from the Fed. Chair Jay Powell saying that it's likely to take, quote, longer than expected for inflation to reach the central bank's 2% target. So let's get right to it. The three things that you need to know at your roadmap for today's trading day. Yahoo Finance's Jennifer Schomburger, Rick Newman, and Pras Subramanian have more.
Futures hanging on to gains this morning, even as Federal Reserve Chair Jay Powell says it will likely take longer than expected to gain confidence that inflation is moving sustainably back towards the Fed's 2% target, likely signaling it will take longer to begin cutting interest rates.
Right now, given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us.
Powell's comments marked a shift in the Fed's outlook after 3 straight quarters of hotter than expected inflation.
Plus, President Joe Biden looks to raise tariffs on Chinese metals. The White House says it is exploring the possibility of tripling the current 7.5% tariff on Chinese steel and aluminum imports. The Biden administration also calling on the U.S. Trade Representative to probe Beijing's potential unfair trade practices in shipbuilding. Biden will make the announcement in his address to Pennsylvania union workers later today.
Plus, United soaring past Wall Street expectations, shares up 5% on the results, driven by strong demand and a rebound in business travel. But United faced high-profile issues this quarter, including challenges with the Boeing 737 MAX 9 groundings that cost the airline $200 million in profit. Speaking of Boeing, the latest company whistleblower testifies in front of the Senate later today.
Well, today's top story, stock futures are rising this morning, holding on to gains after the Dow snapped a 6-day losing streak on Tuesday. This comes as earnings once again take center stage while the Fed continues to signal that rates will remain higher for longer. So let's take a look at the broader market action that we're tracking here on the day. First and foremost, you're taking a look at where things moved yesterday for the Dow Jones Industrial Average. Let me pull up the futures here for a hot second here as we calibrate to the Wi-Fi Interactive and dust off the Dow futures here. Taking a look at that, that's up 0.1%. Nasdaq 100 futures, that's pointing higher by about 0.25% as well. And the S&P 500 futures also pointing higher by about 0.3%. I'll show you some of the Nasdaq move that we're seeing here pre-market as well. And we'll just put the extended hours on this so you can see a little bit of what's shaping up coming into today's trading activity for some of those mega cap tech stocks, largely seeing some fractional gains across the board. And for the sector activity that we're also tracking, you're seeing mostly green. Looks like energy is set and poised to open up the day just a little bit lower here. But just toggling back very briefly, I want to take a quick look at some of the yields that we're tracking this morning as well as that for the 5, the 10, and the 30-year. You're seeing those fractional declines across the board still hovering above 4.67 for the 5-year. And then additionally here, just take a brief look at gold. We'll ride out with that as we're kind of continuing to keep a close eye on where things are moving in all business of gold. And as of right now, sitting at 2,400. So all you people who bought gold bars at Costco, that's your update for right now. Shauna?
All right, Brad, thanks so much. Let's start off with that broader market action here. We got to take a look at the S&P 500 because it's dropped just about 4% this month as investors worry about the Fed potentially delaying its first rate cut. Despite, though, those recent concerns, we've got our next guest who says a higher for longer scenario actually isn't necessarily bad news for stocks. Brian Belsky joining us here at the desk, BMO Capital Markets Chief Investment Strategist. So, Brian, weigh in. Everyone's worried about it. You can see it clearly reflected in the market, but maybe it's not necessarily bad news.
It isn't, Shauna. Thank you so much for having us. Good morning, Yahoo. It's just great to be here with the Smiths. You know, we became a little bit more cautious on a near-term basis about 6 weeks ago, and several people questioned, you're not bullish anymore? No, we're bullish. And in fact, 12 years ago today, we launched U.S. strategy product at BMO, and we said, listen, stocks have entered a 25-year secular bull market, and that call remains the same. However, we do believe that momentum and the FOMO trade and got a little bit ahead of itself. I think the key thing that you said in your preamble was earnings remain the litmus test, the key. And from a fundamental perspective, earnings are stronger than everybody thought. I think I know most people thought we were heading into this March cut. I think the last time I was on your network, I talked about, I saw no analytical evidence that we're going to see some sort of a March cut, but yet so many people are so macro focused in that they're looking at Fed funds futures and giving Fed funds futures so much credit, whereas I think we're missing the kind of forest through the trees. Here's the forest through the trees. Since 2007, this has not been normal. This has not been normal since the great financial crisis. Pre that, very normal. And in fact, if you look at the correlation between interest rates and stock markets, it's basically meh. However, in a higher interest rate environment, certainly higher than 0 to 1% or 0 to 2%, stocks traditionally do very well. So I think we're recalibrating that. We still think from these levels, stocks are higher at year end. Now our official year end target is 5,100. Our bull case is 5,500. We published that in November. So we think that the market post earnings could get a little bit softer and give us an opportunity to be a little bit more aggressive in terms of buying stocks lower.
Does that mean new all-time highs then? Investors should expect, even if we don't see any rate cuts this year?
Yeah, so that's a great question. And so when we came out with our year ahead in November of last year, we said there's a very good chance the Fed's not going to cut at all because the employment situation fundamentals are so strong. And I think people didn't really notice that because, again, so many people are so focused on Fed funds futures. But what we think is going to end up happening is this return to normalization in terms of the average 10-year treasury over the last 75 years is 5%. So if we can hover between this 4 and 5% range and still have strong employment, but most importantly, have very strong earnings and oh, by the way, cash flow, I think the market can do very well as we continue to migrate and understand that North American stocks are the place to be.
Yeah, talk to us a little bit more about that normalization process in terms of where investors should be positioned, maybe companies or even sectors specifically that you expect to hold up a little bit better as we do see that normalization.
So we have the very good fortune at BMO to run 12 separately managed account portfolios for clients, real life clients in both Canada and the United States, and then 2 ETFs. So we look at stocks from a bottoms-up basis, and we think that most investors are massively underexposed small mid-cap. Doesn't mean that you're going to go and buy all small mid-cap. For instance, if you had $100, only 8 of that $100 is comprised of small mid-cap stocks on a publicly traded base in the United States. That's Apple and half of Microsoft. Think about that. So if you're a stock picker, right, you're salivating at that because then you can say, hey, I can have tracking error in my portfolio and add some really great small mid-cap franchises. That being said, to answer your question, from a large cap perspective, we like tech and financials. It's not all the Magnificent Seven, because remember, the Magnificent Seven aren't all tech stocks. That's number one. Financials, we love the money center banks. The really small banks, so bifurcated, very big banks and very small banks, and asset managers and brokers. And then in mid-cap areas, we like communication services, consumer discretionary, as well as tech.
When you talk about this earnings season and what we're going to be listening for, what is the theme that needs to prevail this earnings season in order for some of your targets to be within sight?
Great question. Earnings consistency is the key. And I think from so far that we've seen, especially in the big financials, they've beaten numbers for all intents and purposes. And analysts have been very negative financials. And we think a big part of that has been over-reserved. And I think we're going to see more buybacks and more dividend growth. But at the end of this, it's not just all about AI, right? It's not just about those big cap tech stocks that have an AI attached to it. It's really more about productivity and continued gains going forward. And from an earnings perspective as well, free cash flow yields is very important.
Brian, when it comes to investor sentiment right now, because like you said, a lot of people like to still call you one of the biggest bulls on the street, but your price, your target for the S&P is still 5,100. Is that right?
Officially, yeah.
Any odds that you're going to increase it just given the run-up that we've seen? I know you're talking about the return to normalization and what that's going to look like here in the market, but any reason to be a bit more optimistic than maybe you were at the end of 2023?
I'd love to tell you my secret. I just love to, but I love my job more. So here's normalization, okay? Because this is my 35th year on Wall Street. I'm the Doogie Howser of Wall Street. You can look that up, millennials and Gen Zers, if you don't know what that is. So high single-digit to low double-digit performance in the stock market. Same thing for earnings. A trading range for treasuries, whether or not it's 3.5 to 4.5 or 4 to 5. Okay. In average multiples, you know that the average multiple pre-Great Financial Crisis was actually 2 multiple points higher than since 2007. So again, I think we're heading into kind of a mid-90s environment before tech, and where we were really more stock pickers. And if you look back to the early 80s too, we were small, mid-cap, and more stock picking too. So I think that's the environment we're heading into for the next 3 to 5 years.
Brian Belsky, BMO Capital Markets Chief Investment Strategist. Brian, great to see you as always.
Thank you. Appreciate it.
Absolutely. Thanks for setting up today's trading activity with us. Also, another huge story that we're tracking ahead of the open, and more broadly, President Biden looking to triple tariffs on Chinese metals. This coming ahead of his visit to the United Steelworkers headquarters in Pittsburgh today. For more on this, we've got Yahoo Finance reporter Rick Newman on set with us. Hey, Rick, what do we know about this so far?
Well, not unexpected. Biden has been paying a lot of attention to China. And let's just remind everybody, Trump was the first to put new tariffs in place on Chinese imports, and Biden left those in place. And now he's saying we're going to push them up a little bit. So the tariff now is about 7.5% on Chinese steel and aluminum. Biden is saying let's push it up to 22, 23, 24, 25%. And when by the way, when he says he's asking his trade representative to look into this, that means he's going to do it. That doesn't mean the trade representative is going to say, no, not such a good idea. It's going to happen. So we have more protectionism. I mean, this is the way it's going. If Trump wins in November and becomes president again, he's talking about 60%, 60% tariffs on Chinese imports. Now, what he did last time was he said a number, I think back then it was 45% in 2016. He didn't do 45%. He did about 1/3 of that. So if Trump says 60%, let's assume it wouldn't be 60%. But he says 100% tariffs on electric vehicles. And we've basically got both parties at this point saying we need to do something about China basically flooding global markets with cheap goods. And I think this kind of protectionism is here to stay. Economists don't like it. It's a barrier to free trade, but I think it's just a political reality at this point.
Rick, how is the Biden administration balancing it? Are they balancing it? Because when you square this with the diplomatic outreach that has been going on, at least recently among the administration, we just said Yellen in China meeting with top government officials last week. What is this going to ultimately, do you think, do to U.S.-China relations?
Well, I think that there is an important difference between Biden and Trump on this. What Biden has done with regard to China is very targeted. One big part of Biden's policy is export controls on advanced technology from the United States, trying to limit those products. He's saying certain things you can't send to China no matter what. What tariffs are no, and that's mainly with regard to weapons programs that China's developing. So Biden doesn't want sophisticated American technology in Chinese weapons. Again, that's very targeted. Trump just came out and said across the board tariffs on all Chinese imports, but then he kind of backed away from that. So what Trump did was new tariffs on about half of all Chinese imports. That was just across the board. And mostly what Trump did was he targeted components, intermediate products that don't land themselves on shelves, so consumers wouldn't see suddenly the price jump by 15 or 20%. It would go into the supply chain. He basically exempted consumer products like computers, electronics, things like that, toasters, so that people wouldn't see that price change. But Trump was more across the board. So Biden is being very targeted. And let's also remember, every time this happens, the target country basically retaliates with a similar tariff on U.S. exports to that country. So when Trump was doing that, China was putting tariffs on a lot of American products, including food, farm products, soybeans, pork, things like that, which cause a lot of heartache for farmers in the United States. So for Biden to say very targeted tariff on only this one set, and by the way, we don't even get that much steel and aluminum from China anymore. Maybe he will limit the retaliatory damage and not sort of be scoring an own goal by hurting U.S. producers.
I mean, and the other thought about this, too, is how much of this kind of tit for tat is also trickling down to the mindset of consumers and being more nationalist almost with their purchases at the same time.
Well, it's a funny thing because when you add tariffs to imports, stuff in the United States gets more expensive.
Right.
I mean, that literally raises the cost. Somebody has to pay that cost. And everything we're talking about here, more tariffs on Chinese imports, whether it's small targeted tariffs or across the board, that is all inflationary. And when Trump was president, we didn't really have much inflation to worry about. We do now. So I think this is another reason for Biden to be very targeted. And by the way, I think it's a good guess these tariffs might not even go into effect until after the election. By the way, we still buy a ton of stuff from China. Yeah. If anybody who thinks, oh, all that stuff on Amazon now comes from Vietnam or India, it ain't so. Just look around on Amazon. Most of that stuff still comes from China.
Yeah, I was going to say, it gets pretty obvious pretty quickly. All right, Rick, thanks so much. Let's take a look at United, because United Airlines shares are taking off this morning after posting a narrower than expected loss for the first quarter. The company, though, did cite a $200 million hit from the Boeing groundings. Despite that, though, you're still looking at gains of about 6%. Pross, remaining here to break this all down. And Pross, pretty strong results, especially in the face of the hit that we were just talking about from Boeing groundings.
Yeah. I mean, that narrower than expected loss. If they didn't have that loss because of the groundings, they would have had a profit for the quarter. So I think there's some enthusiasm there from investor community, better outlook for the quarter coming up from a profit point of view. We're seeing robust demand for both domestic and transatlantic travel, so that's really good there. But you mentioned that Boeing hit, the $200 million hit because of the groundings. CEO Scott Kirby not happy about this, talking about how Boeing needs to kind of own up to these things, and then they need to basically make up for the loss that they've suffered here. They're going to go to Airbus for some other planes to kind of match up what they're missing from Boeing's kind of delivery schedule coming up. So not all good news here. They have to cut pilot hours as well. So it's looking good from a point of view of a demand point of view, but also a little bit shaky from can they get enough planes to do what they need to do for the next couple of years.
Yeah, it's really interesting, especially on the pricing side too. And we were having a conversation over near our desks just about where the demand has actually outpaced in the early innings of 2024, 2023, which was that new marker post-pandemic of, okay, now we've got to top 2023's numbers. And 2024 is doing that. And the question of how much that's actually passing through to the revenue that these companies are seeing right now. I mean, revenue was really only up per available seat mile by about 1% in this quarter for United as well here.
Yeah, I guess it's kind of hard to top those good numbers last year.
Yeah.
I mean, I know you spoke to the Delta CEO too. Also, they're seeing the same kind of growth as well, both domestic and both business as well as leisure travelers. So I think that's sort of I think people are surprised at the sort of activity here, travel activity here, both from commercial and also just people like you and I.
Absolutely.
All right, Pross, thanks so much for breaking that down. We're going to have analyst reaction coming up later in the hour. But first, we're going to take a look at Tesla. Tesla is asking shareholders to vote on Elon Musk's compensation package yet again. We've got that story and more of today's top trending tickers when we come back.
Tesla has once again asked shareholders to vote on a $56 billion compensation plan and package for CEO Elon Musk. This is the same package that was voided earlier this year by Delaware court. They are also calling for a vote to move the company's incorporation from Delaware to Texas. This comes as Barclays this morning warned that next week's Tesla earnings could drive the stock price even lower. There you're taking a look at shares right now. They're up pre-market by about 0.7%. But let's show a year-to-date chart, if we may, because it's been a slippity slide here for TSLA shares and its shareholders certainly wondering, okay, when will things start to turn around? Is it management decision? Of course, this is the company that also just announced layoff plan of about 10% of its workforce, and so that also something that investors have had to price in recent sessions too.
Yeah, exactly. I think this is just really building up all the pressure that Tesla is going to be facing, not only in its earnings and earnings call here that's going to happen in just about a week from now, but also looking ahead to that shareholder meeting that's going to take place in 2 months. And Dan Ives is out with a note here from Wedbush earlier this morning, and I think really just putting it into context here for everyone, just saying that there's fireworks right now into this shareholder meeting. Clearly, the performance has not been up to par, to say the least. You've got shares off more than 30% since the start of the year. He called the last 2 Tesla calls have been a, quote, train wreck, bad comedy shows with no adult in a room. He's talking about the lack of guidance, the lack of communication, and you can see that frustration, I think, clearly reflected in the stock price, in shares off 36% since January 1st. And really no stopping here this trend to the downside. We talk about the fact that a number of factors are obviously challenging Tesla's position at this point. Obviously, the biggest factor is the lack of demand. That is something that not only Tesla is struggling with, obviously many of its rivals are struggling with as well. But you can clearly see that shareholders are frustrated at this point. And I'm saying that the clock has struck midnight for Musk now to lay out the growth strategy and give realistic delivery and margin goalpost here for shareholders.
I'm still just hung up on this use of the word fireworks. I mean, that's such an absolute value term coming from Ives there, where it's either striking and amazingly brilliant to the eye when you see it go off in the sky, or it could drive your dog crazy. I mean, at the end of the day, one way or the other.
The latter.
Yeah, I think he really threaded the needle with the use of that one there. So good friend of the show, Dan. Excellent stuff there.
All right, guys, let's take a look at Abbott Labs, because that's on the moves this morning. Reported earnings that beat expectations for the first quarter and also raised the low end of its full-year profit guidance. Yahoo Finance's Anjali Kamlani has the details for us. Anj.
Yeah, that's right. And as you saw on the screen, the stock is down just a little bit. As looking at the volume of trading, there is what investors are saying. They're just waiting till post the call to see how it works. But looking at what the company reported, we know they beat on not only for the quarter but also raising guidance, so about $10 billion there for the quarter. And that is despite the fact that they are still getting a little bit of drag from the COVID testing. That diagnostic segment still a little bit down as you look at quarter over quarter. But on the upside, their new Libre, or rather the Libre product, the medical device for glucose monitoring, that's been their strong point, up 23%. And that is also something that's interesting as part of the GLP-1 story, because despite the fact that you've seen other companies sort of get hit with negative outlooks based on that, they're actually seeing an increase in use of their glucose monitoring devices as GLP-1s take off. So that has been an interesting story for the company. Meanwhile, looking across at of course, the nutrition sector, we know that the baby formula story is still, is actually in their past right now. They're definitely picking up pace from the loss that they experienced a couple of quarters ago. So all in all, kind of a flat, I would say, on balance quarter for the company. So that's sort of where things stand right now.
All right, Anj, thanks so much for bringing us the latest there on that. Again, Abbott Labs, a name to keep in mind in today's trading session. All right, let's also take a look at shares of Adidas, because they're moving to the upside, up 8%. The company raised its profit target for the year. A bit of a surprise here for investors and shareholders as the company gets a boost from strong demand for its Samba sneakers. Rick Newman, I think, was just wearing them on set here with us moments ago. And the remaining sales of its Yeezy brand. So again, it looks like at least Adidas regaining some of that loss of momentum. It has struggled just a bit here over the last last several quarters. So again, these results, Brad, coming as a bit of a surprise here to the street. And as a result, we're seeing that reaction to the upside with shares look on track, right? It is actually trading to the upside, up just about 8%.
Yeah, better than expected is even how the company defined it themselves. Better than expected performance during the quarter, increased their full year guidance, expecting currency neutral revenues, which actually in Q1 were up by about 8% versus the prior year levels. They're expecting that to increase at a mid to high single digit rate. And for all the Yeezy fans, wearers, I mean, it's not Rick Newman. Rick Newman's got the Sambas, as we saw on set. Very fashionable man, by the way. Also, the Yeezy drop here, we got to point back to that. Revenues of about 150 million euro, operating profit about 50 million in the first quarter, but this is the last time that they're expecting to see a profit there. No further profit contribution during the remainder of the year is what they're saying they expect as the remainder of the inventory and the sale of the remaining Yeezy inventory during this year in 2024 is going to happen on average just at cost. So what it costs them to make it, that's what they're expecting it to go out the door, and the price realization.
Yeah, UBS saying that these results is going to make Adidas one of the, quote, best earnings momentum stories in the space. So a name, I guess, to keep on your radar here if we do continue to see that momentum to the upside as they work through what was a very challenging 2023 for the company.
You know what? I will add this. It's been a big year in the basketball category for them, especially thinking about the success of Anthony Edwards. Anthony Edwards has absolutely become and cemented himself as a household name in the NBA over the course of this year. He's got a brand new shoe that's out, and I picked it up. Actually, you know, I do my channel checks.
Yeah.
I did my Foot Locker channel check
yeah, I checked
yesterday.
out your sneakers. I was looking to see if you
well,
were
these are
one
the
of
book ones, but for the new Anthony Edwards shoe and the launch of that and the entire campaign they put around that, I think it was really well executed. So in the performance category, that's perhaps where they're also seeing a little bit of pickup this year too.
Yeah, we certainly are seeing that momentum here to the upside. All right, we'll keep right here on Yahoo Finance. We've got much more of your market action ahead. Again, you are looking at all three of the major averages on track to open the trading day in the green. We'll be right back.
Oh yeah, big opening bell energy. Lots of green at the Nasdaq. Love to see it. Team coordinating outfits. We should have done that when we rang the bell.
We should have.
We kind of did.
We'll do it next time.
We did our best. Anyway, we opened the markets, and that's all that matters. They're doing the same there at the Nasdaq and at the NYSE. You've got a live look at both as we begin today's trading session. All right, what are we seeing out the gate?
A bit of a mixed picture here. Let's start with the Dow. The good news, the bright side of things, at least here at the start, moving to the upside, up just about 150 points. You got the S&P also trading to the upside above the flat line here at the open. And as we wait for the Nasdaq here, actually opening right now to the upside. So all three of the major averages opening the session in today's in positive territory. Taking a look at the bond market action, a bit of a reversal from that move higher that we've seen in yields over the last couple of trading days, now falling just around 5 basis points. And also, Brad, the sector action here and what we're seeing on an intraday basis, energy and real estate, the only sectors here opening the day in the red.
Yes, but look at XLB. My goodness, materials ripping to the upside by about 0.7% to start the day here. And of course, over the year-to-date scale, it's been one of the positive performers, up by about 4.5% here. Of course, we've got even more coverage of the opening bell.
We certainly do. Allie Canal standing by in the newsroom with a closer look at some of the trending tickers on our platform. Allie.
Hey, Shauna. Yes, let's kick it off with the #1 trender on Yahoo Finance right now, and that is ASML. The Dutch company is the biggest supplier of equipment to computer chip makers, but it did report weaker than expected new bookings in the first quarter, which is why we're seeing shares fall today, down about 5%. It's been a mixed reaction on Wall Street, with some analysts saying that order intake was expected to be a bit lumpy as the industry has been dealing with slowing demand over the past year or so, as well as higher prices. That being said, though, 2025 is expected to be strong amid greater demand for memory chips, along with the AI boom. The company also reiterated its full-year outlook for 2024, which is another bullish sign for investors. Next, I want to bring it back home to United Airlines. Shares are jumping today. We're seeing it up nearly 8% right now after the airliner reported a narrower loss than expected in the first quarter, with operating revenue also beating estimates. Guidance for the current quarter also came in strong, although the company did post a $124 million net loss following the 3-week grounding of Boeing 737-9s after a door plug flew off an Alaska Airlines jetliner earlier this year. Boeing, of course, is going to be in the spotlight today with back-to-back Senate hearings in D.C. That's something we'll be tracking all morning. And then finally, I want to round things out with a little luxury. LVMH, the company which owns designer brands like Tiffany and Dior, saw shares rise despite the fact that we saw a decrease in quarterly revenue. Overall, though, the results were pretty steady, especially given the fact that there's been greater concerns over slowing demand as prices remain high, especially in China. So overall, a better than feared outlook on Wall Street, with analysts saying that the worst has largely already been priced into the stock. So by and large, Shauna, people are still buying Louis bags, and for now, that's a positive for investors.
Certainly is, and a positive for those who are able to afford it right now. All right, Allie, thanks so much. Let's take a look at ASML, one of the stocks that Allie was just talking about there. ASML shares are under pressure. Now, this comes after Europe's biggest tech firm's net sales fell nearly 22% compared to just a year ago. Now, to break this all down and the tech giant's earnings and what it means for the broader chip sector, we want to bring in Jas Versteeg, Insinger at Gillison's Equities senior analyst, is here to discuss. Jas, it's great to have you here on Yahoo Finance. So first, just give us your reaction to that drop that we're seeing in shares of ASML and what this really signals maybe about lack of demand or maybe worry about demand here going forward.
No, that's absolutely not the case. There's absolutely no lack of demand. And you also already said it, that the order flow is always very, very lumpy. Just remember that in the last quarter of 2023, there was an order inflow of more than 9 billion. And in the second half of the year, 13 billion. So it's just lumpy. And ASML already said for a long time that you never look too close to the order inflow because, yeah, it doesn't say too much. It absolutely doesn't express that the market is weak at the moment.
So do you think the market's getting it wrong then, the fact that we're seeing this drop of 5%, if you're not worried at all about that this doesn't throw any cold water on the optimism for 2025?
Yeah, absolutely. They also said it, and I'm absolutely not shocked by it. But if you look to the semiconductor monthly sales, like the SIA always produces, you'll see that the upturn is a little bit hesitating. We see for 4 months in a row year-on-year growth, but the last 2 months it was declining a little bit, the semiconductor sales. So the market could be a little bit hesitating. And then when you see this order inflow of ASML, I can understand that people get shocked. But yeah, ASML already also said sometimes that it could be that there is an order and they are already working on an order, and still the order is not officially checked in. Sometimes even when they are on the point of exporting it to the client, it's still not signed, because when you sign the order, you have to pay a down payment, and sometimes it's difficult to pay that down payment. So order inflow, I just say don't look at it. It's just the long term, and they were very, very positive about the long term. Still for 2025, they said they only need 4 billion for the coming 3 quarters. So 4 billion per quarter, only 12 billion, to get a revenue of about 35 billion in 2025, and that's 30% higher than 2024. So no worries for ASML for me.
I think what a lot of investors are trying to figure out is how long of a tail does the AI trade have with relation to ASML in comparison to some of the other large semiconductor plays that are out there right now?
Yeah, I think this will continue for many, many years. They already made an estimate for 2030 that in the coming years, the semiconductor market will double to more than 1 billion, but it's 1,000 billion, I think. So today it's 500 billion worth. So it will double in 2030. That will be a growth of more than 10%. So the market is very good for semiconductors. There's lots of demand for logic in the AI chips, but also for memory in the AI chips. High bandwidth memory. There's a lot of demand there. So I'm absolutely not worried about demand for ASML in the long run, especially when you look to AI. But also, we see a very strong trend of electrification. We try to get our energy from windmills and from the sun. And you also need a lot of semiconductors for that. We see a strong trend in electric vehicles. So there's a very strong long-term demand for semiconductors. And ASML is exactly in the right spot, I think.
Yeah, so talk to us just about what the pricing strategy looks like here going out and some of the pricing trends that you're comparing to when you take a look at what ASML is able to produce here, how that stacks up to some of its rivals within the space.
Well, actually, they actually don't have rivals. They are the only ones who can produce the most advanced machines. They still have Nikon and Canon in Japan, but they only produce low-end machines. And there are no real competitors. Pricing for ASML has everything to do with how good the machine works. And they just made a new machine which works very, very well, is much more efficient than the other machines. So they can ask a higher price for that. And most of the clients, especially all the clients, are happy to pay a higher price if the machine is more productive.
And so I guess that's the key question here too, is that if you have enough clients that are willing to produce what they need to with the lithography system and then resell, there's kind of that secondary market of used equipment rather than just having to buy a brand new lithography system. And I think that was something that was a concern prior.
Yeah, sometimes it can be in the short term, but I think the reuse of systems is a very small market, and it's not anything to worry about that for ASML. The point is actually that these machines, they are good for a very long time. Nearly all the machines, the modern machines from the 90s, I think, are still working. So there is a market for reuse of the machines but it's very small. It's never a big concern for ASML.
Yes, I'm curious just in regards to the U.S. crackdown on China when it comes to access to chips, and also Europe being brought in to some degree into the standoff that's happening right now, or the tensions that are rising between the U.S. and China. How exposed is ASML, just given the fact that they do rely on China for a large portion of their business? Is this something that's worrisome to you at all? And if not, why?
Yeah, that's a good question, because when you look at the revenue from system sales, it was nearly half of the revenue China. But that had everything to do with the low revenue in the first quarter. From the fourth quarter last year to the first quarter now was a decline of about 30%. And when you look to the revenue part of TSMC, Taiwan, it was only 6%. So the biggest client had only 6% revenue in the first quarter. So, and that makes it that China is relatively big in this quarter. But normally it is about 20% or so from the total revenue of ASML. And then ASML is still able to sell lower end machines and mid-critical machines to Chinese companies. And it's only about the high end machines. And there it is a little bit trouble. And when you look at that in revenue amount, then it's about 5% or less. So China is not a big worry. And they always say, like, if they don't build it in China, the high-end chips, they will build it somewhere else. And I think about half of the chip companies in China are foreign companies, and they will go out China. So it will only be lower-end Chinese companies, and they buy the lower-end machines. And they will still buy it for a long time. And they're very much investing in it. So they want to really to win that market. So they invest a lot of these lower-end machines.
All right, top trending ticker on the Yahoo Finance platform just reported earnings, and they're expecting 2024 total net sales to be similar to 2023. We'll see what they put forward and continue to give us updates on Jos Versteeg. We certainly appreciate the conversation this morning. Insinger Gillison, Equities Senior Analyst. Thank you. Well, coming up, everyone, United Airlines shares moving higher after posting a narrower than expected loss, but the company could not escape Boeing problems. We'll break down the report after the break.
Let's take a live look at United stock. Look at that, shares jumping, now up over 10%. They moved to the upside coming after the company reported better than expected quarterly results. And this comes despite losing $200 million due to troubles with Boeing's MAX 79 fleet. The company is only reporting a loss here of $124 million in Q1. Again, that was better than what the street was bracing itself for. So we want to bring in Nick Owens, Morningstar Industrials equity analyst. Nick, it's great to have you here. So first, just your take on United's results here, and really what that signals about maybe Boeing's troubles isn't going to be as big of a drag on United going forward as many analysts had initially feared.
Yeah, I think that's fair. I mean, in a way, you could say that the damage here was pretty limited. They had whatever it was, 50, 60 planes that they had to ground and inspect. And, on $11 billion plus in revenue for the quarter, they're saying it was a $200 million hit, which was the difference between them making money or losing money. So to me, that just goes to show how narrow the margins in airlines really are.
You know, I'm taking a look at and comparing some of the broader industry stats, specifically on the TSA traveler throughput. Looks like they kept pace broadly with the roughly 6% higher passenger throughput that we're seeing in 2024 versus 2023. But on pricing and the revenue per annual seat mile, looks like in aggregate that was only higher by about 1%. Just wondering what you make of that, Nick.
Well, I would say first quarter is not usually the best quarter or the most representative quarter, so they're kind of positioning for the busy summer, and so not all the revenue and cost stats will necessarily be representative from the first quarter, in my view. What I did notice was they had a nice jump in the Pacific routes, which they tend to benefit from, and that's, I think, because of the slightly delayed reopening that came out of China.
Nick, you are
There's still some more legs there.
Yeah, Nick, when we look at maybe a little bit of a longer-term view, you are still a bit cautious. What are the biggest challenges facing United, and could you make that same argument with its rivals, some of the other larger competitors as well?
Yeah, I would say that the group faces a common set of challenges, and to flip that around a little bit, they are benefiting from a common set of tailwinds right now. So even though it's frustrating that they can't get their hands on the planes that they ordered, and they maybe couldn't hire as many pilots as they wanted to, and the FAA can't hire as many air traffic controllers, what that's doing is actually putting a crimp on capacity expansion for the industry, which means they get to charge more for the same seat. So, they've been booking record revenue and record yields on less than 2019 capacity. My concern then is that if you fast forward a year or two, and the planes and the pilots and the air traffic controllers start coming back online, if you will, and if consumers take a break or sort of level off their spending, what does that look like for profitability for the industry? Within that, United, I think, is fairly well positioned. They have a nice premium offering. They've been doing a great job modernizing their cabins, and they look a little more like Delta than they used to. And so they might do okay. But here we are on a 10% up quarter, $11 billion in revenue, and they barely broke even. So I just think that when CEOs are saying things like, I've never seen such a constructive environment, you want to ask yourself, well, how long will this last?
Right, and commentary that we'll probably hear continue on the earnings call. That is not until 10:30 a.m. Eastern time, I believe, here. So we're going to be waiting on the edge of our ergonomic seats here, as I always say, for what that commentary is. What do you need to hear from the company and the executive team right now as it relates to the myriad of headwinds that you laid out, but specifically how they're going to need to lock in the demand environment here from consumers, given the resurgence in corporate travel, which is tending to provide them a little bit more on the margin side, plus this leisure traveler that we're going to see exactly where the propensity to continue to spend into the airline experience looks like?
Yeah, like I said, I think United's doing a good job, and what I think we're seeing is the big three, Delta, United, American, have positioned themselves to be able to take share from so-called low-cost providers. So I've been thinking about it in terms of they're doing a better job, and even with like the evolution of the business traveler and the leisure travel and so forth, they've moved away from rigidly segmenting on business versus leisure, and they're just saying, how much are you spending on your travel, and what can we offer you? Within that, I think of it as the back half of the plane looks a lot like a Southwest or a Frontier cabin, maybe even with a slightly better experience. And so they're able to compete on some of those routes, and they're taking share there. So they've been talking that up, in terms of direct relationships with the customer through the app, refitting their cabins and so on. They're also talking about paying down debt, which is great. And that's what I'd like to hear in terms of just being positioned to withstand what would be a normal downturn some here in the next couple of years.
Should customers expect prices to go higher from here, Nick?
Yes. It will be, I think, another year and a half before Boeing gets a go-ahead to produce some more 737s. And so I think you'll see a kind of plane shortage story unwinding. So they'll be using older planes a little bit longer and so on and so forth, and just generally not being able to grow the capacity quite as fast as they had originally hoped. You saw some talk in the announcement here about reshuffling their order book and so on, and other airlines are doing that too. Right. So what I'm driving at is slightly less growth in capacity, and as long as we still have this resurgent post-COVID travel demand, that just means prices will go up.
By how much?
I don't have a percentage, but I've been joking with friends and family that like 400 is the new 250 for an airfare,
Interesting. Nick, thanks so much for
like that.
Yeah, seriously, right? Nick, thanks so much for taking the time. Really appreciate it. And we know you'll be listening in very eagerly to that earnings call once it starts as well. Morningstar Industrials equity analyst Nick Owens. Thanks so much.
Thank you.
Coming up, everyone, AMC surging today. We dive into what's behind the upswing. That's next. Taking a look now at AMC, which is up again this morning. Yesterday, the stock rose over 10% despite no apparent news, their largest percentage gain since February. Last week, AMC Chief Executive Adam Aron did say that Chapter 11 bankruptcy is, quote, inconceivable. Really interesting here as we've continued to track the moves in AMC Entertainment over the past 2 days. Yeah, we talked about that move yesterday. Net in aggregate, 2 days up 16% right now.
Yeah, and I think this also just points to some of the frenzy that has been surrounding these types of names and meme stocks when we talk about the volatile movements that we've seen in AMC, especially over the last several weeks, comparing that to some of the volatile moments or the volatile moments that we've seen in Trump Media. Taking a look at that stock, that has really been among the trending tickers here at Yahoo Finance over the last several days. And taking a look at the recent drop that we've seen, and then actually today's gain, a bit of a bounce back here of just about 70%. But the stock, though, has plunged nearly 70% from the peak last month. So a lot of selling action in some of these names that really are not trading in tandem with fundamentals. Clearly, that is a topic that we've been talking about. Nothing new there. But when you see these wild moves in a name like Trump Media and a name like AMC, clearly it's getting our attention. It's getting retail investors' attention. And much of that action really being driven by the activity of retail traders. And then also the public debut of Reddit as well. That has also put the spotlight on this meme trade once again.
Yeah, absolutely. It's getting memey again. Memetic is what it's short for, everyone, just in case you were wondering the scientific terminology behind it. But at the end of the day, looking at some of these wild moves higher in the swings that we've been tracking, I mean, companies like Fun, ticker symbol PHUN, I'd seen that, tracked that move higher a couple times this year by about 400% during a single trading session on multiple occasions here. And so all these things considered, I mean, it's almost like once again, buyer beware. There's not a get rich quick that you can just easily execute more often than not. And, you know, for some of these companies that are totally detached from fundamentals, it's wild to say the least to still see this happen.
Yeah, and you got to keep that in mind, right? If you're going to be buying into one of these names, clearly maybe you could be lucky and be buying on one of these dips and see massive gains. But on the flip side, you also got to be ready to lose it all, right? Because it's not trading any sort of fundamentally based, and clearly then that really lacks any sort of trigger that really could be to the one side or the other, or really any reasoning behind some of the movements that we are seeing. All right, we'll keep right here on Yahoo Finance. Much more ahead. Madison Mills is going to be joining me here at the desk, and we are going to be continuing to cover today's top stories. That's including Boeing whistleblower set to testify to Congress. That's going to get underway in just a bit this morning.
That's right. And I'll be back here at 11 a.m. for Wealth, where we're going to be discussing United's earnings and what it could mean for your summer travel plans. Stay right here.
Welcome back to Yahoo Finance. I'm Shauna Smith alongside Madison Mills. We're 30 minutes into the trading day. Here are top 3 stories that we are following. First, starting off with stocks coming off a 3-day losing streak following hawkish messaging from Fed Chair Jay Powell, who said that it would be appropriate to give restrictive policy more time to work. You're looking at gains across the board. The Dow now up just over 120 points.
And those gains following that hawkish commentary, but also fueling the gold rally, with gold holding steady near its record highs, looking flat to relatively unchanged. And that is coming despite higher bond yields and a stronger dollar, both of which are typically headwinds for the precious metal.
And Boeing is back in the hot seat as 2 Senate committees are set to scrutinize a plane manufacturer's safety culture. The first hearing is getting underway now. A panel of aviation experts are testifying in front of the Senate's Commerce Committee. And then later on this morning at 11:15 a.m. Eastern, the latest Boeing whistleblower will testify before the subcommittee on investigations. Now, for a deeper dive into one of those big stories that we are watching, we got to start with Boeing. An independent expert panel is testifying before a Senate committee on Boeing's safety culture. Now, this hearing will be followed by another at 11:15 a.m. Eastern time, where we will hear from a whistleblower who's going to lay out some concerns about the company's 787 Dreamliner jet. Joining us now, what we can expect and what this ultimately means for Boeing, our very own Alexis Keenan. Alexis.
Hi, lady. Yes. So this first hearing, it is basically an agency within the FAA that's going to be giving a report to lawmakers about their findings on a report that was looking into the safety culture at Boeing. And what they say in this report that is on paper right now, we'll hear their testimony to get more color on this, is that there is a disconnect between the senior management at Boeing and the rest of the organization. And they say that is causing problems in internal safety culture at the company. But secondly is this 11:15 hearing, and that will also be in front of Senate lawmakers. And that is going to be from Boeing quality engineer turned whistleblower. His name is Sam Salapour, and he is expected to call for the worldwide grounding of the 787 Dreamliner. That's that wide-body jet that Boeing has struggled to get off the production line in the expedient fashion that they had wanted to back in 2011 when these planes started to come off of the production lines there. Now, there are 13 of these planes in service, but what Salapour is saying is that in his experience working on the Dreamliner, he says he was since retaliated against by Boeing and moved to another section of the company. But he said that gaps in the fuselage of this plane, which is made by different companies and comes together at the Boeing factory, that the gaps, which are about the width of a human hair, that they're too big and they're too wide, and that under the stress of flying conditions over a long period of time, that the plane could actually break apart in midair. Now, those are some serious claims. That's why he's saying he wants this plane to be grounded. But in response, here is what Boeing is saying. They say that these claims about the structural integrity of the 787 are inaccurate. The issues raised have been subject to rigorous engineering examination under FAA oversight. This analysis has validated that the aircraft will maintain its durability and service life over several decades, they say, and these issues do not present any safety concerns. Boeing held a reporters' briefing on Monday to elaborate on what they mean here. And what they say is that the stress conditions, the testing that they have put this aircraft under over its time being in production, that they have gone far beyond the lifespan in testing this aircraft from what would be expected. They say that they have put it through 165,000 takeoff and landing pressurization scenarios, and that would be 3.75 times the designated lifespan of this aircraft. So they're saying something widely different than Salapour is saying, but we're expecting a lot more detail as we listen to him later this morning.
And we're looking at live footage right now from Capitol Hill, as well as this first hearing that you mentioned starts to kick off. I'm curious, though, how much are we going to learn today? How much news can we actually get out of this, particularly given some of the executive changes that have been going on at Boeing?
Right. So we aren't going to hear from Boeing at this hearing. we're invited to have a voice here, so we're not going to hear that. We're not going to hear a response. Certainly, I would think Boeing would want to have a controlled response to these very, very serious planes. These planes are in the air. There are 13 of them that have been delivered to customers. But look, we don't know. He's represented by counsel, Salapur, so we might very well learn more about the details of these gaps. Boeing has put out quite a lot of information about their design and their testing, but maybe he will have some insight as to why he thinks that 165,000 hours is not enough. Boeing has certainly said along the way that already the aircraft in service, they've been tested as well. They undergo regular service requirements, and they say in those conditions, then too, they did not see any problems with these gaps in the aircraft. So maybe a lot to learn, maybe a little to learn, but we'll certainly bring you the information on the backside of this hearing.
All right, Alexis, thank you so much for bringing this to us and for covering it as it breaks here. Really appreciate it. We are going to continue to cover stocks here moving higher after over half of the S&P 500 stocks hit their one-month lows on Tuesday. That is the most since the 2023 banking crisis. And this comes after Fed Chair Jay Powell said that it could take longer than expected to tame inflation. Investors are now repricing the likelihood of rate cuts this year with a 58% probability of rates staying at their current levels in that July Fed meeting. That is according to the CME Fed Watch tool. For more on this, we are joined by Jerome Schneider, PIMCO Head of Short-Term Portfolio Management. Thank you so much for being here with us this morning. I know that you've mentioned that there's a lot of noise in financial markets, and that's why we're seeing so much whipsawing when it comes to the data, when it comes to Fed speak. What do you make of the reaction that we've gotten to Fed Chair Powell's commentary?
Yeah, we've come a long way over the past few months, and rationally, investors have continued to recalibrate the data that's come into the marketplace with regards to inflation, and more importantly, with regard to the more higher than expected growth patterns that we've witnessed. From that perspective, we actually are getting an emphatic response from the central bank here. Both Chairman Powell as well as Vice Chairman Jefferson yesterday emphatically said that we are simply seeing inflation too high in the data, that they can't ultimately move to a lower benchmark rate as a result. So the easing bias that many people had expected earlier in the year seems to be evaporating here pretty quickly. The markets have actually digested pretty well this information, especially over the last few pieces of not only job data, but also inflation data. But from that perspective, we're seeing the markets really digest that we are going to have higher rates for longer. And in doing so, we are finding that risk assets generally have tolerated it. Yields have moved higher in calibration, expecting this higher for longer mantra. And investors really should begin to think what that means for their portfolios longer term. And ultimately, what we're finding here is that yields are relatively attractive, really attractive compared to where we've been in the longer term. But in the near term, we're finding that there's a lot of fair value to be had in the front end of the yield curve, really the 0 to 10-year space to be more precise. And in that construct, what we need to do is construct portfolios, think about the opportunity sets that the Fed has effectively afforded us because the fact that they're going to be on hold for a little bit longer than they expected. And more importantly, when we ultimately see them begin to cut, put yourself in the position to have some price appreciation in bonds by adding a little bit of interest rate exposure to this point, given the rationalization and recalibration to the higher rate regimes that we've seen in the recent weeks. 30 basis points over the past 4 weeks or so across the curve is something to really put us into that fair value range. And we think that it's an entry point for investors to begin to consider adding a little bit more to their fixed income component of their portfolios.
Yeah, Jerome, it makes sense, just the opportunity that you're seeing here for investors to kind of lock in some of those higher yields. I want to get, though, more specifically to the movement that we've seen higher, especially when you take a look at the move in the 10-year, when you take a look at the move in the 2-year here. How much higher do you think yields are potentially going to go, at least at the short end of the curve, with this concern about this higher for longer scenario? I guess how much of that do you think is priced in at this point?
Great question, Shauna. We're ultimately seeing a rationalization that there's probably going to be a little bit less than 2 rate cuts over the course of this year and a handful of rate cuts next year. I think there's, while on one hand, we're probably in the vicinity of fair value for both the 2-year and the 10-year point, I think investors are trying to be a little bit too precise in terms of handicapping and actually trying to predict what the Federal Reserve is going to do. While there is a negligible possibility that the Fed does not cut rates this year, the reality is they're probably going going to signal at least some accommodation along the way, however modest it is. From a practicality perspective, it's probably the 2025 outlook that investors really need to begin to think about, not necessarily from the fixed income perspective, but what higher rates for longer mean for risk assets around the world. And ultimately, if we don't see as many rate cuts that are forecasted in 2025 come to fruition, that could actually have some type of effects on the pricing of risk assets and the appetite of risk assets in the longer term. So in the near term, we actually expect the Federal Reserve to do two things: probably continue to push out their expectations of rate cuts in the near term, and then more importantly, pivot to a less important facet of the policy effort, which is focusing on their balance sheet and begin to adjust their quantitative tightening, which is in the background and really doesn't necessarily have much impact to rates and risk appetite, but is an important component of monetary policy as it has been in recent years. So we'll begin to see some modest adjustments in their messaging along the way. But again, Jerome Powell has been emphatic in the near term and will continue to be so about defending inflation. As we get longer into his term and closer to the 2026 expiration of his term, he's going to be really focused on one thing, which is focusing on how inflation has been diminished and approaching that 2% threshold. And he's going to do what it takes to do so, even if it means delaying the rate cuts along the way. Near term, I think that this delayed easing cycle will unveil a series of opportunities, as I mentioned, to really optimize allocations around the investment world, favoring a little bit more fixed income along the way, despite the prognosis that Fed cuts might be pushed out a little bit longer at this point in time.
And I'm curious, as we start to wrap up here our conversation about what we're seeing in the 2-year and the 10-year, is the growth story the same for both of them? Is one a growth story, one an inflation story? Are they moving off of the same narrative, or is there a difference there?
It's very possible, but very, very important that growth and inflation are coming in a metric for across the curve. But the inflation metric is a little bit more poignant in terms of that 10-year point for several reasons. While the 2-year point is more susceptible to Federal Reserve policy changes, specifically benchmark rate changes, which currently are affected by inflation data, longer term, the term premiums that you'll see further out the curve in the 10-year sector and the 30-year sector are really predicated upon term premiums driven by longer-term inflation expectations as well as supply considerations. And so when you have that in play, you're really thinking about how the shape of the yield curve, which is still negative, mind you, by about 30 basis points, needs to recalibrate to a more normalized level where 2-year yields and 10-year yields are equivalent, and eventually reflect a normalized yield curve where 10-year yields are higher than 2-year yields. That will happen over time, but currently doesn't reflect that. And in that case, inflation and term premiums have much more effect out the yield curve, which is why at PIMCO we're thinking about the yield curve as having a steepening bias over the intermediate term.
Jerome, outside of the U.S., are you seeing opportunity in international bond markets, and if so, where?
Without a doubt. And I think this is where a differentiation and where the U.S. exceptionalism is actually creating opportunities for investors. On one hand, while we think we're pretty close to fair value in some yield determinants in the United States, when we look around the world, we're going to see some more aggressive central bank policies toward easing, reducing benchmark rates in the near term. Those places are such as Canada, Australia, even England in that matter, and the ECB. We could find ourselves in the world where those central banks move more aggressively versus the United States and create some outperformance, meaning their yields will move lower, creating some price appreciation compared to the United States fixed income position. So we are finding some of those relative value opportunities across our portfolios, not only in the short term as we encourage investors to move out of bills and into some longer term fixed income, but also more broadly speaking as we look at to relative value for investors who hold for the longer term fixed income in their portfolios.
Jerome Schneider, we really appreciate your insight. Thanks so much for taking the time to join us here this morning. PIMCO, head of short-term portfolio management. Thanks so much. Well, coming up, Boeing's first hearing is underway on Capitol Hill. We will bring you the latest from D.C. when we come back. Boeing is in the spotlight today with two back-to-back hearings on Capitol Hill. The first hearing is currently taking place where aviation experts are testifying before Congress regarding Boeing's safety concerns. You're looking at live pictures of that hearing right now on Capitol Hill. Now, the second hearing is going to include a Boeing whistleblower, which is set to start at 11:15 a.m. Eastern time this morning. Well, Boeing has denied the claims surrounding the safety of its 787 Dreamliner aircraft. We just heard from Senator Ted Cruz a few moments ago, and here's what he had to say about Boeing's current situation.
While it is clear that Boeing's culture and safety management needs drastic improvement, we should not rush to legislate just for the sake of legislating.
For more on what to expect from these hearings, we want to bring in Richard Safran. He's Seaport Research Partners Managing Director and Senior Analyst. Richard, it's great to have you here. So Boeing is facing multiple investigations from regulators, also from lawmakers. Just your assessment of what we're expecting to hear from the two testimonies happening on Capitol Hill today, and how significant this could potentially be here for Boeing.
Good morning. Thanks for having me. So first off, I'm a bit cautious, and I think investors should treat this with a bit of caution, skepticism so far about the claims made so far in the 787. So I wouldn't necessarily act on what we've heard so far. I think second point is, I think a lot depends today, to your question, on the evidence that I understand from the attorney involved is going to be presented today. If the claim has merit, there should be some documentation that Boeing signed off, knowing that there were defects in workmanship, and that could affect the useful life of the airplane, or at least some data that would support the claim that refute what Boeing's been saying about the useful life of the airplane. Now, if the claim has merit, to the impact question you asked, if the claims have merit, big if, obviously this would be a devastating blow to Boeing on the order of what we've been seeing with the MAX. Aside from the likelihood of another production call, if there is a known defect, there would be penalties, investigations. All the airplanes in service would need to be repaired at some point if this is determined to be a safety of flight issue. But, I think the main point here right now is that we've seen no evidence whatsoever yet that I'm aware of, or data to support the claims that the whistleblower has been making. So I'll be eager to see what's presented today, if anything.
Richard, how much do you anticipate us learning today, given that executives are not going to be speaking? I know you mentioned wanting to hear more about the data piece. What are you going to be listening for, given, again, that we're not going to be hearing from executives at the top of the company today?
Well, the company has responded prior to this hearing, to these whistleblower hearings. And I felt it interesting that they went out and replied with two line managers on the 787 with data. So to answer your question, what I'm going to be looking for today is the evidence that's going to be, what I think we're going to learn is what evidence there is to refute what Boeing has been saying, the quality of that evidence, and whether or not this whistleblower's claims have any substantiation to them. I think that's probably, in my view, the most important thing I think you're going to get out of the hearings today.
Richard, I think customers would probably argue the evidence is the plane having parts fly off during flight. What do you make of that piece of things, the idea that consumers' image of Boeing has already been tarnished by this, and therefore, of course, that could put pressure on the stock moving forward?
Well, first off, good point. Those issues, with the door, of course, were on the Boeing 737 MAX. The whistleblower appears to be making claims, as far as I understand it, on the Boeing 787 and some on the Boeing 777. So first off, just a bit of a nuance there, but a different one. But your point is well taken. Boeing needs to do three things here. They need to understand lessons learned, develop a good understanding of what the issues were, what went wrong, implement the changes, and hopefully the new CEO and the 90-day plan that we're working on right now does that. They need to execute. After the dust settles, management needs to keep execution as top priority. And as you say, a major thing here that they need to do is restore the brand, restore the public trust, That includes regulators, customers, as well as the flying public, people like me, who want to get on these airplanes. So I think that's really an important point right now, as you say, that they're going to have to make an extraordinary effort to restore the brand and the trust.
And Richard, to that point, we've also seen this willingness from Senator Cruz, we just played a clip at him at the top of the interview, included just in terms of ramping up that oversight. What do you think, just in terms of what we hear today, how today's hearing, or do you think it at all is going to give us a better idea of how that oversight could potentially shape up and what it could ultimately look like?
I think it's pretty clear we're going to have more oversight. I don't think, since the plan isn't complete, and there hasn't been a lot of time between when these incidents first cropped up, that the FAA has a clear understanding of what actions it needs to take. So I'm not expecting a lot in terms of being able to answer your question today to come out of the hearing about what actually is going to be implemented. There already have been, certain changes made, et cetera. But the changes that Boeing is going to make and the regulators are going to need to make, I think, are still being ironed out. And I think you're going to have to wait at least until the 90-day plan is completed and they've had a chance to figure out how they're going to implement that.
Richard, we're going to have to leave it there, but thank you so much for joining us and giving us your insights on Boeing. Really appreciate it. That was Richard Safran, Seaport Research Partners Managing Director. Well, shares of Eli Lilly are rising this morning on news that its weight loss drug helped reduce irregular breathing in patients with sleep apnea in recent late-stage trials. Here with the details, we have our very own health reporter, Anjali Kamlani. Anjali.
That's right. This really adds to the list of what we know Zepbound, Eli Lilly's GLP-1 product, is going to be set up for. We already know that these GLP products are being looked at for solving multiple problems, and now Lilly has an opportunity to, it says mid-year, apply with the FDA for an expanded label for Zepbound. This adds to what we also know Novo Nordisk just got, which is the cardiovascular benefit. If we look across the board, there are a number of other opportunities that both Lilly and Novo Nordisk are looking at. That includes liver as well as kidney treatment. So there are a number of other opportunities that we're going to probably be seeing coming down the pike. But as of right now, Eli Lilly gets this one with the benefit for sleep apnea, improving or rather reducing the number of incidents throughout the night in which the airways are obstructed. And so that is the good news that they've had in this late stage trial. And like I mentioned, going to be applying with the FDA for that expanded label so doctors can prescribe it for that purpose, as well as, the 20% reduction in weight later this year.
All right, Anjali, thank you so much, as always, for bringing us that news. Now, coming up here, the S&P 500 has been on a wild ride this month. Is the path higher going to be any smoother? We're going to discuss that coming up next. Stocks are climbing higher almost an hour into the trading day, looking like a mixed picture across the board. So the Nasdaq just switched over into relatively unchanged territory here. Not a ton of momentum, though, with the S&P 500 snapping their 3-day losing streak after dropping over 3% over the past couple of days here. That coming after strong economic data and sticky inflation causing investors to question rate cut expectations. So is the market still pricing in smooth sailing for the Fed? Likely not. Our very own Josh Schaefer here with more. Josh, what's going on?
Yeah, probably not smooth sailing, right, guys? And I think that's sort of what investors should expect, even though that's not what we got for the first quarter, right? So we wrote today in our Yahoo Finance Morning Brief newsletter, specifically in our chart of the day. It was from Keith Lerner over at Truist, and he highlighted this chart here, which is your average decline that you see in the S&P 500 in a given year. The average pullback there is your dotted line. That's 14%. Right now, this year, we've only had an intra-year pullback of 4%. This is basically to say, on average, all else equal, we normally come back a little bit more than this. And I think it was just a good reminder for people after this just sort of ripping rally that we've had over the last couple of months that it is okay for stocks to pull back. It is normal for stocks to pull back. There are plenty of strategists that would come on this air and might tell you it is actually good for stocks to pull back and not just go up in a straight line. And I think the other thing to point out with that is if we do get a bigger drawdown, right, and you think about some of the years you saw in that chart, 2020, 2016, 2010, 2009, we had rather massive drawdowns in those years. You could see the light blue dots go significantly down. Pick out a year like 2020, just a couple years ago. The drawdown is huge, but stocks actually close higher for the year. So basically to say, be patient, weather the storm. That seemed to largely be Keith Lerner's advice from Truist here. But he did say he thinks the path forward is going to be a little bit bumpier, guys. And I think we heard some of that this week in commentary from Chair Powell and other news.
We have heard that. And also to his point there, you look at some of the fundamentals of the market, right? Especially when we were just talking to Belsky last hour, and he was saying it all comes back to earnings, right? We could talk all we want about what the Fed is going to do next. Yes, ultimately does matter at some point here, but really the driver of the market this year and what is really riding on is how strong earnings results are going to be, not only for this quarter, what we're in the middle of getting right now, but also what that path forward looks like for the rest of the year. And you couple that with the fact that the economy obviously has remained resilient, which is good news here for earnings here going forward. And then also the fact that, yes, we have seen some volatility within the commodity market, but we haven't seen huge spikes to the upside, right? When you take a look at the price of crude, when you take a look at some of the other movements that we have seen. So with those risks kind of being outlined, and Lerner talked about this in his note too, it points to the fact that, yes, going back to what you were saying, this momentum to the upside here, or reasons to be positive on the market going forward, those calls still remain intact.
Oh, definitely, right? And we're going to get a lot more information on that over the next couple of weeks, too, I think. And I think that will help sort of maybe drive a more clear picture for the rest of the year. Right now, consensus expects earnings in Q4 to increase year over year by 17%. That's a big number. Like, that's a really big number we're talking about there. And if you want to argue that since that's been consensus for a little bit now, it's priced in to some extent, as it comes down, how does the market react? What do we hear about guidance, I think, for the rest of the year out of this quarter is going to be a big deal. Right now, one stat I was looking at this morning, guys, this was over from Evercore, which just stocks are seeing a much larger negative reaction if they miss on EPS and sales in the next day than they normally do. Only about a little over 50 S&P 500 companies have reported in Q1. This is per Julian Emanuel. But he saw a 10% decline in stocks that miss on EPS and revenue the next day. That is more than double earnings. If you're not living up to those expectations, or maybe if you're JP Morgan even raising those expectations to where people want them to be, you don't quite see the stock reaction, right? Yeah. And again, keep in mind, a stock like JP Morgan had rallied over 40% in earnings, right? So maybe it didn't need to go up any higher, but I thought that was a little interesting tidbit when you look at a big company like that has done very well this year, not raising it to the level that people want. I think will be something to watch, maybe perhaps especially into tech earnings.
Exactly.
The expectations are pretty high there.
Yeah, and that's great to point out, right? Because just meeting expectations, clearly not good enough for the market, especially when you take a look at the current valuation levels, like you were just saying, and specifically in some of those names that have really outperformed the broader market by a wide margin.
We're still very close to all-time highs. Yeah. Like, that's something to keep in mind. Yes, we've pulled back a little bit, but we're still pretty close to as high as we've ever been. You're going to need a real reason to keep moving higher.
Yeah, makes sense. All right, Josh, thanks so much. Well, the great rate debate continues whether or not the Fed is going to cut, when the Fed is going to cut. Fed Chair Jay Powell signaling that rates could actually stay higher for longer as inflation remains stubbornly high. So let's listen to what he had to say on that yesterday.
So we've said at the FOMC that we'll need greater confidence that inflation is moving sustainably toward 2% before it would be appropriate to ease policy. The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence.
So let's talk about that rate cut timing and what it could look like. Joining us now on that path forward, we want to bring in Lauren Baker, an economist with ITR Economics. Lauren, it's great to have you here. Thanks so much for joining us. So just give us your perspective in terms of Fed Chair Jay Powell saying, hey, maybe it would potentially make sense to wait a little bit longer for that first rate cut. What is your base case right now? And what does that ultimately mean here for the economy?
Well, the CPI result last week, and certainly his comments yesterday, did push back consensus a bit. We had been more confident in a June cut. I still think June is not off the table entirely. I don't think 3 rate cuts this year are entirely off the table, but the movement at this point is pushing back toward a September for being the timing of the first cut. We do have a lot of data coming still before that June meeting, so we'll see if March was just a blip or if that is more of a consistent trend.
What is it going to take to make not only the market, of course, but also the macro viewpoint kind of suffer from the amount of data that we're getting? I understand that the commentary is now that this is bumpy and this is just the path towards disinflation. But when does that start to buckle? And when do we really start to say, yeah, June is just, it's not going to happen?
Well, I want to be absolutely clear. We are nowhere near the story of disinflation buckling. So even though that March number did come in slightly higher than expected, there was a tick up, especially in certain components. We are still well off those highs of CPI that we saw last year. So the disinflationary story is still very much intact. We never want to assume a trend out of just 1 month of data. But again, the path to 2% is what we're questioning. How long does it take to get there? I don't think we have to get to 2%. Jay Powell's been very clear on that. We don't need to reach 2% before the Fed begins cuts, but we do have to be moving, as he said, consistently in that direction.
What do you think is going to give them a bit more confidence? What level would you say? Not exactly, but just giving us a better idea. If it's not 2%, what do you think that range then potentially is?
I think what's more important even than the headline CPI number is the wage inflation data. So the Fed does want to see the labor market cool off. Wage inflation has been one very sticky aspect of inflation. We see a lot more cooling in, say, the goods side of the world than we do in the service sector. So service costs need to come down. Wages do need to cool off a bit. That's what's going to give the Fed more confidence that we're moving consistently in that direction, that cuts are merited.
And I know you know also that the U.S. consumer continues to be strong with the labor market, which of course is part of the Fed's dual mandate, and that's certainly part of the thinking there, Lauren. Thank you so much for joining us. Really appreciate it. That was Lauren Baker joining us to talk about what's next for the Fed. Now, coming up, does the gold rally still have legs? We'll speak with a strategist on what's next for the precious metal. That's after the break.
All right, well, stocks have really been off to a strong start of the year overall. The AI excitement really fueling that momentum to the upside. It's pushed the major averages to those all-time highs. Now, for investors looking to buy into this craze, there's more ways to play AI than maybe those obvious names when you're thinking Nvidia and Microsoft. Morgan Stanley out with a recent note looking at companies that are actually powering AI, calling out a few of those hidden AI gems. Joining us now, we want to bring in Stephen Bird, Morgan Stanley equity analyst, to discuss. Stephen, it's great to have you here on Yahoo Finance. So talk to us just about your thesis here, because I think a lot of investors, when they're thinking about joining in on AI, they want to get a piece of this massive rally. They're thinking of those obvious names. You're, though, looking at some of those companies that's powering AI. What's the real opportunity here for investors and why?
Yeah, thank you for having me. The opportunity really here is around the infrastructure. It's very understandable. The first port of call is Nvidia. We understand that and support that. But the infrastructure required, everything from power generation, power electronics, data centers themselves, that growth rate is set to accelerate. Many of those stocks have not participated in the rally that the first derivative AI plays really have, and that's essentially the call.
So talk to us then about your data center economics model in particular. You talk about how the cost of compute is falling. What is driving that, and what does that indicate to you about certain trends that investors should be keeping up to date with?
Yeah, I have to say I was very surprised at the results of our assessment of data center economics. We see about a 50% drop in essentially the cost of compute, cost of computation in these data centers. That's really all NVIDIA. It's these new chips that are just much more efficient, and that's flowing through the entire ecosystem. As those costs drop, we think demand for a variety of Gen AI applications will rise, and that's essentially the thesis of our view of Gen AI adoption across many industries. That's just going to spur demand higher, and that's going to create even more demand for the infrastructure, for the nuts and bolts, all the power that's going to be required for all these data centers.
Stephen, how underappreciated do you think this opportunity is at this point by investors?
You know, it's interesting. There are a few obvious plays that are part of the infrastructure dynamic, but there are many, many companies that are key enablers that are not well understood. So, for example, Bloom Energy, a fuel cell company, the stock has not done well. And yet that's the type of technology that can allow data center companies to very quickly get new data centers operational. Whereas Constellation Energy, it's a stock we like very much, ticker CEG, stock has done very well. We support that. We really walk through in detail the economics. For a big nuclear player like Constellation, it's very likely that we're going to see extremely large data centers, really essentially supercomputers, sited at existing nuclear plants. So that idea has captured a lot of investors' attention, whereas other names like Bloom really has not gotten any attention at all.
And when you look at Bloom, Constellation Energy, and you mentioned that they're not getting a ton of attention, which is great for our audience to hear. Maybe it's a good time to get in. But what was the biggest thing you looked at in terms of the fundamentals when sussing out those picks so we can try and kind of mirror your understanding?
Absolutely. So one thing that also surprised me about our analysis is time. What I mean by that is for data center developers, for hyperscalers, time to getting powered up is absolutely critical. It's incredibly valuable economically. So we looked at a variety of companies that can essentially speed up the time to power. Constellation can do that with their existing nukes. You can fairly quickly site data centers at a nuke. Bloom Energy's fuel cells can be deployed in 50 days. And so that's a very fast solution that I think the market is missing. What we're used to seeing with data centers, just connect the data center to the grid, then get some renewables, you're good to go. That's running into problems now because the grid is so congested. So Bloom provides a solution at a low cost. It's just been missed because the conventional thinking hasn't really fully changed into this concept that, look, the grids are constrained and time is absolutely critical. So that's really the lens we've been looking at.
And Stephen, put this opportunity even in more perspective for our viewers. How early are we in this adoption cycle when it comes to AI? And then what does that tell us just about some of the future gains and the future growth that we could see from some of these companies like Bloom Energy that we have up on the screen?
That's such an important question. We think we're very early days. And I say that because we look at the pace of NVIDIA chip evolution of chips from others as well. We look at the future compute that's going to be needed for Gen AI more broadly. we see very rapid growth. Gen AI growth in terms of electricity growth is going to be about 100% a year for many years to come. And what's interesting to me is as the cost of compute drops, new use cases show up. So the demand for compute is only going to go up and up. We're extremely early days in this dynamic. And now investors are just really starting to look across what I think of as the value chain to providing the power to these data centers. So we're very early days in that regard.
All right, Stephen Bird, great to have you here. Thanks so much for hopping on with us on Yahoo Finance, Morgan Stanley's equity analyst. Thanks so much, Stephen. Let's do a quick check of the market. It's just about an hour and 15 minutes into the trading day. You're looking at gains for the Dow and the S&P. The S&P just above the flat line. The Dow, as I'm talking here, falling back into negative territory, as well as the Nasdaq. The Nasdaq off about 0.1%. We'll be right back.
We're going to do a quick commodities check here, starting with WTI crude dropping below that critical $85 a barrel this morning. And this is coming after a U.S. government report, by the way, showing that there has been an increase in inventory. And of course, following Iran's attack on Israel this weekend, awaiting kind of that geopolitical tension to continue to fall out here. But we see that oil has been moving a lot over the course of the day. I want to take a look at the past 6 days here just so that you can see the amount of volatility after oil had hit those highs last Friday. I also want to take a quick look at what we're seeing with gold. If we continue to see this bifurcation in the commodities space, gold up a little close to 2.5% over the past 6 days here, in this coming as we're seeing movement in the bond market going higher and also strength in the US dollar. So that's a little bit weird when it comes to the movement that we are seeing in gold. And then I want to end by taking a look at our old friend Bitcoin, struggling here in the trade, seeing that they're down about 0.8%. I want to pull up what Bitcoin has been doing year to date just to show that that's a little bit abnormal, right? We've been kind of around this trading range here for Bitcoin, starting to see it dip below that critical level. So question remaining about whether or not we're going to continue to see more downside for Bitcoin moving forward.
All right, Maddie, well, let's zero in on one of those commodities that you were just talking about, and that is gold, because we have gold hovering just around that record high. The precious metal up over 15% since the start of the year, thanks to sticky inflation in the U.S., also geopolitical tensions abroad. So how much more room is there for gold to run? We want to break it all down with Jim Steele. He's HSBC's chief precious metals analyst. It's great to have you here, James. So let's talk about this run-up that we've seen in the price of gold, because we have prices studying right around those record highs. What do you think the movements of the last few trading days, what does that tell us then about potentially, or lack thereof, much more room to run here to the upside?
Well, I think you have to look at the, thank you for having me, by the way. And I think you have to look at the genesis of the move. And in addition to geopolitical risks, which are significant, we've also had a lot of extraneous players coming into the market in the past several months who I think are not so much interested in the price of gold as such, but they wish to hedge their equities exposure. There's a lot of debate in the equity markets about how high equities can go, and many managers, fund managers, pension managers, et cetera, have no alternative but to be in equities. But they do have a choice about if they hedge that risk. And gold is a proven safe haven in that regard. So we pushed it to levels where we've got a lot of momentum trading in now. And I think that's where we have to be somewhat concerned that if we get some days where things are static, we could easily get a pullback in the price. And in addition, we're seeing a lot of demand destruction on the physical markets going on. Bars, coins, jewelry. It's getting very expensive for price-sensitive economies to keep buying the underlying physical.
So is there too much greed in the gold trade right now?
Well, greed's a term that I wouldn't necessarily use, but I think what we've seen is signals that have brought in a lot of momentum traders, and they may or may not be well versed in the fundamentals of gold, but the signals have been there to buy, because as you pointed out, the market's gone to near record highs in nominal terms. I would point out for your viewers that gold hit $850 an ounce in January of 1980, which if converted into today's dollars is around $3,200. Now, I'm not saying we're going to go there by any stretch of the imagination, so please don't think I am. But I would point out that from a real term perspective, we're not at historical highs.
What do you think these high prices tell us just about the odds that some of these central banks are going to liquidate some of their gold holdings? Does that make it more likely? And I guess what's the ultimate impact then on the price of gold?
Well, so far they've been good buyers.
Yeah.
Almost 1 out of every 3 ounces of gold that was mined in 2022 went into a central bank, and not much less in 2023. Now, I think we have seen some slowness this year. They're aware of the price as well, and it is high. It's possible that for some gold-producing countries, we could see some central banks have been sellers. The IMF released data a couple of days ago that showed a couple of central banks were sellers in March. But I do think over the long haul that central banks are on balance on a committed buy program, but they certainly don't have to buy at the rapacious rate they did in the last 2 years.
Jim, I'm going to have a cross commodities question for you in our final minute together. We're seeing that the dollar's stronger, yields are higher, and gold is rallying. And typically these things are inversely correlated. What do you make of the movement that we're seeing across those different assets?
You're absolutely right. And that's a very astute question. And this is not usually a good sign. There's a lot of fundamental economic argument to argue that gold is the world's supreme hard asset, the dollar is the world's supreme paper asset. They should be inverse, and they usually are. And when they both move up together, it's usually a sign of elevated risk. But it also doesn't last in the long run.
All right, well, we're going to have to leave it there. That was really helpful, Jim. Thank you so much for joining us. Jim Steele, HSBC Chief Precious Metals Analyst. Now, the Bitcoin halving is nearly upon us. Every 4 years, the reward for Bitcoin mining is cut in half to reduce the amount of coins in circulation. To break down what this means for crypto prices and stakeholders, we have our very own Brad Smith. Brad.
Hey, yes, one of the largest crypto events just days away. Why does Bitcoin halving happen, though? That's the big question that many new holders or hodlers might be asking. Well, it helps keep the currency scarce so it stays valuable. In the past, we've seen the price of Bitcoin rise after the halving, but it's not guaranteed. On the other hand, not great for miners. Companies like Marathon and Riot, the rewards that they generate will diminish, and talks of consolidation will probably make its rounds here. Now take a look at some of these crypto miners that we've got pulled up here on the Yahoo Finance Jumbotron behind me. And one of the huge things, even if you look out more broadly over the year-to-date performance, all of these companies are down, and down bad. When you think about the number of companies and the amount of output and energy that they need to continue to make sure happens in order just to mine now a smaller reward for Bitcoin, that places even more pressure on their operating costs. So that thrusts them very much into the conversation of whether or not they could be a target for an acquisition. But all of these things considered, it's going to be interesting to also track some of the other major cryptocurrencies as well here, because that is noteworthy, especially in the Bitcoin halving, where there is another new event for many potential buyers to enter into the market across the cryptocurrency landscape. But make no mistake about it, it is another massive event for Bitcoin, and for all of the ETFs that have come about, this makes it even more of onus on them to know exactly where they're purchasing Bitcoins to go, or Bitcoin to go into their ETF holdings that they have with new inflows of customers as well, or purchasers into those ETFs. So all of these things considered, Bitcoin year to date still up 38%. Larger question of where do we move after this newest halving coming forward in just days? Shauna, Maddie?
So technical event, but it sounds like it could have a massive ripple effects here when we talk about the prices of Bitcoin and then, of course, the miners and everything that you just laid out there. Hey, Brad, great stuff. Thanks so much.
Got it.
Well, we're 90 minutes into the trading day, so let's take a look at where things stand right now. And you're looking at red across the screen. Dow, S&P, and Nasdaq all trading to the downside. You got the Nasdaq as the worst performer of the three major averages, off just about 0.33%. But stick it right here, keep it right here on Yahoo Finance, because coming up, our brand new show, Wealth. Brad is right there with the W on the screen, has all your personal finance needs. He will have you for the next hour. Stay tuned.
You hear the music, you know what time it is. Welcome to Wealth. I'm Brad Smith, and this is Yahoo Finance's newest guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. On today's show, oh my gosh, yes, vacation, all I ever wanted, vacation, have to get away. Summer travel. We have an expert to give you the tips and tricks to book an affordable fare out there, and housing hurdles, quite like my being able to announce and pronounce affordable. We'll bring you the math that's giving and keeping housing inventory so low. Plus, your new family car. Yahoo Finance tries out the all-new 3-row electric crossover SUV from Kia, the ride-along that you can't miss here. We're about an hour and a half into today's trading session, though, and we want to bring you 3 of the driving factors moving today's markets. Here with more, we've got Yahoo Finance's Alexandra Canal. Hey.
Hey, Brad. First up, let's take a look at the major averages. We're looking at a bit of nothing here across the board. All 3 major averages largely hugging the flat line here as both the S&P 500 and Nasdaq Composite look to snap a 3-day losing day streak. Commentary from Fed Chair Jerome Powell pushed those indexes lower on Tuesday after the central bank leader said the Fed needs to see more progress on inflation before cutting rates. And the travel sector also in focus today with 2 back-to-back hearings centered on Boeing. The first is underway with an independent expert panel testifying now before a Senate committee. The panel saying there is a disconnect between senior management and the rest of the organization when it comes to Boeing's safety culture. As for the second hearing, we are just minutes away. Starting at 11:15 a.m. Eastern, a whistleblower will lay out his concerns about the company's 787 Dreamliner jet. He is expected to call for the global grounding of those planes. The double hearing comes as United Airlines reported a $200 million hit from Boeing's 787 MAX 9 groundings that happened earlier this year. Both United and Boeing are top trending tickers on Yahoo Finance today. Plus, we are tracking oil prices. Crude falling below $85 a barrel, the 3rd consecutive day of declines following Iran's weekend attack on Israel. Gas prices have risen slightly over the last week, with the national average sitting at $3.66 a gallon. That's 4 cents higher from 1 week ago. Brad?
All right, Ali, thanks so much. The 3 things moving markets here today. Let's turn to a trending story now. United Airlines' first quarter earnings report. Shares of the airline rising after reporting an upbeat forecast for the second quarter, despite incurring a $200 million loss in Q1 from the grounding of the Boeing 737 MAX 9 aircrafts. The airline also cut its expectations for the number of ordered aircraft that the operator will receive this year. If you're a United traveler or just planning your next trip, there is a big takeaway, and it has to do with consumer demand. In the first quarter, United counted over 39 million passengers. That's up nearly 7% from a year ago. That percent change is slightly exceeding the increase in TSA screenings, which is 6% higher compared to 2023. We also know from United's report, people paid about 1% more per available seat mile in the first quarter for their flights. So what does that tell us? The demand for airline travel continues post-pandemic, and people are paying more, albeit not too much more, for their flights. On the earnings call, the United Airlines executives saying that the airline's continuing to see some positive demand across all consumer segments right now. Shares having their best day in about a year, a little bit over that, up by about 12% right now for ticker symbol UAL. Well, United was the latest airline to report its quarterly results Tuesday. Despite its latest issues with plane groundings and safety concerns, it managed to report a narrower loss than analysts expected, thanks to the continued high demand for travel that airlines have seen these last few months. So can we expect the demand picture to remain this hot through the summer? That very topic that they were talking about on the earnings call. Joining me now on this, we've got Brian Kelly, founder of The Points Guy. Brian, great to speak with you. Great to get some tips from you as well, even amid this high demand environment that all of the airline executives are speaking about. I was listening into the United executives on their call. I spoke with Delta CEO Ed Bastian last week after their earnings. How can consumers still find deals in this environment of high demand?
Yeah, there are still deals out there. You know, I'm booking some European trips right now, so I'm in the thick of it. I actually just saw in August, what I'm noticing in June and July, I think due to the Olympics especially, airfares are much higher. August is normally the more expensive month, but this year I'm seeing better deals. New York to parts of Italy for $4,000 in first class on British Airways, I was finding yesterday. You know, last summer we saw business class $5,000, $6,000, $7,000 fares across the board. So there is, you know, while I think I agree that airfare this summer is going to be about the same as last year, there are still deals out there. And my biggest tip for those searching for flights, use Google Flights, so google.com/flights, and click the Explore tab. And what the Explore tab will do is, instead of just putting in your home city and then one city in Europe or Asia, wherever you want to go, you can actually search from your home airport to an entire continent and hunt out and sniff those cheapest fare deals. Because especially within Europe, it's really cheap to pop around once you get onto the continent.
You know, it's interesting. We were talking with an analyst from Morningstar earlier today about some of the airline results. And for consumers out there, listen up, because as we talk about, you know, 40 is the new 20 with our age and everything like that, there could be a new kind of barometer that we need to look at when it comes to pricing. And here's what that analyst had to say, and then I'll get your reaction on the other side.
I've been joking with friends and family that like 400 is the new 250 for an airfare, you know?
Interesting. Okay, well, brief as it was, at the end of the day, is 400 the new 250 out here?
No, because it hasn't. I think, you know, stats like that are very anecdotal. When you look at the large data sets, you're not seeing mega increases. Now, where I do see that is in luxury hotels. You know, $1,000 used to get you the top tier 4 seasons in Italy. Now that's $2,000 and up at fancy hotels. And it's even creeping up into the $3,000 a night, which I think is just absolutely crazy. It can be cheaper to rent a yacht than stay in luxury hotels these days. You know, I also will be remiss. You can still use your frequent flyer miles. And I think the biggest mistake people make there is you go online, you check your airline, and you assume that there's nothing when you check one singular time, which is just one tiny data point. There are now tools like point.me is now integrated into Amex and Bilt, where it'll actually search all available transfer partners. So they'll search hundreds and hundreds of options, more than you ever could as a human. There's another tool, seats.aero, where you can scan. You say you want to hunt for Air France premium economy seats. You can scan a year in advance. And that's how you snag the best points deals. You can still get 100,000-mile round trips to Europe. You just need to know how to find them.
When is it right to activate your points? I mean, you've got people that are changing the way that they deploy their spending and leaning perhaps less on cash and making sure that they're using the credit card appropriately for travel, but also racking up points that they can then, like we heard on the United call as well, be able to pool in some cases with their friends and family. When is it the right time for people to put those points in play?
Yeah, and I just want to give a kudos to United for allowing that mileage pooling with no fees or penalties. Most airlines will charge you 1 cent per point, which negates the value of the points. United, kudos to you. But in terms of using your points, look, last minute, the airline, if an airline has an open seat, you would be shocked at how many last minute seats they open up at the lowest amount of frequent flyer miles. So if you're a last minute traveler, and airfares at the same time are way expensive because they're trying to take advantage of those people, corporate travelers who have to go last minute. But at the same point, they don't want the ticket going empty, so they'll open it up at the saver level. So I highly encourage, even if you booked this summer and you used a lot of miles, keep checking, because most frequent flyer programs will let you cancel for maybe $50 or free and rebook at the much lower rate. So if you're going to say 50,000, 100,000 miles by rebooking, even a day before, it can very well be worth it.
Hey, Brian, just lastly while we have you here, and I think a lot of people want to know the verdict on this one. We used to hear all the time that the best day to book was Tuesdays. Is that still the case?
That's all false, and there's so many myths in airfare. And no, going in incognito mode is not going to trick the airlines because they're not going to be able to see you. That's false too. There's no one day that's the best. Now, traveling on Tuesdays and Wednesdays in general is cheaper because most people want to travel on weekends, and business travelers are very Monday, Thursday, Friday. So there are certain days that historically it's cheaper, but I cannot stress enough, the way you're going to get the cheapest fares, teach yourself how to use Google Flights and teach yourself how to use these apps that'll help you get the most value out of your points. A little bit of time into knowing the ins and outs is what's going to save you tons over the long term.
Brian Kelly, the points guy, founder. I guess we could just call you the points guy. Brian.
The points guy, the original.
Like they say, the Ohio State, the points guy. Brian, thanks so much for taking the time. We appreciate it.
Thanks for having me.
Certainly. Turning now to 3 news stories you do not want to miss. Tesla is planning to ask shareholders to reinstate CEO Elon Musk's $56 billion pay gain again after a Delaware court struck down his pay package, but taking a step back, the average pay for the CEO of an S&P 500 company, $16.7 million in 2022. That's over 3,000 times more money in Musk's pocket than another extremely high-paid individual. And according to Indeed, the average mid-level Tesla worker gets a bit over $100,000 a year. Pretty good for the Joe Schmo, but does it inspire them to vote yes on the $56 billion for Musk? We'll see. Well, another big story today, Eli Lilly announcing its weight loss drug helped reduce episodes of irregular breathing in patients with sleep apnea in its latest trials. This is great for the company's bottom line. Could also be good news for overweight patients who spend every month on these drugs. The question being, is it worth the high price for Wegovy or Zepbound? That, of course, for you to decide. We'll see exactly where this continues to move the equity as well here. And Boeing is in the hot seat as well here today. 2 Senate committees are scrutinizing the plane manufacturer's safety culture. The first hearing getting underway now, and a panel of aviation experts are testifying in the front of the Senate's Commerce Committee. And then, coming in just a few minutes, the latest Boeing whistleblower will testify before the subcommittee on investigations. Well, coming up, managing your finances can be overwhelming. That's why you need a financial plan and a community like we've created. And sometimes you need to update that plan. We'll tell you why on the other side of this short break. Managing your finances can be overwhelming. That's why you need a financial plan. So here's what we do know. Writing down your wealth goals keeps you on track to achieving financial success. But there comes a time when the plan you once followed so closely needs some freshening up. So what do you do? Here to weigh in, we've got Martin Seamus, Janney Montgomery Scott, Vice President and Head of Wealth Planning. I mean, it's like the famous Mike Tyson quote, right? Like everybody has a plan until they get punched in the face. Life comes at you fast. And so at the end of the day, how do people, when they do have that hit or that like dose of reality, how do they make sure that they're adequately adjusting the plan along the way too?
Yeah, so here's the thing about financial plans is financial planning fundamentally changes the investment game. It changes it from being about the investments, the products, what you're being sold, and turns it into something about you. And the important part about that is, since it's about you, when something unexpected comes along in the markets, that's separate, right? It's about if the financial plan is about you. So making the financial plan, keeping it up to date, keeping it current, means that you're already always ready for sort of whatever comes along in the market, whatever punch or side swipe you might get as you're moving through your investment life cycle.
And it comes back to just having a plan to begin with. That's right. I mean, just walk through the importance of just setting the foundation for a financial plan as well.
And really, financial planning should begin when you start investing. I think a lot of investors go out and they just start buying investments, they just start opening up IRAs and trying to figure it out one piece at a time. And really, you should be thinking about, hey, let's set a financial plan when you actually start. You know, I often recommend, particularly for children of clients or clients, as soon as they get out of college, start making an income, start having finances, income, expenses. That's the perfect time to start financial planning. It's really never too early.
Finances are emotional. There's a lot of behavior that's involved with it. How can you kind of mitigate or mute some of the more behavioral decisions that might emerge along the way?
Yeah, and that's really, I would almost say, as easy as keeping current with your financial plan. So you make the financial plan and you check back on it frequently. At Janney, we often recommend every year you should be reviewing your plan, making changes based on what's changed in your life, making adjustments perhaps on what's changed in the markets, but really it's about you, the individual investor, when you think about that plan. You know, no less frequently than every 2 years should you be going back into that plan, really updating it, checking to make sure that it's still current and reflects what is important to you. And again, that's sort of what helps you separate the emotions from the market, because the markets can be very scary without that.
I mean, it comes back to running yourself like a business as well at the end of the day.
Absolutely.
And I mean, there's the basic formula of revenue minus expenses equals profit, but then there's the larger question of, okay, what do I do with that profit? Because not all profit is just profit. It's some of it goes to savings, some of it goes into other investments. What's a good rule of thumb that people can perhaps, at least if they're loading up their Excel spreadsheet and listening to this right now, begin to divvy up what that profit bucket looks like?
Yeah, and I love the analogy of it's like a business. And one of the things that we often hear with a business is pay yourself first. And it's really the same thing with a financial plan. You should pay yourself first. So first go through and check your savings. Make sure that you're maxing out your retirement contributions. If you're eligible for a 401k, make sure you're maximizing the matches that you get from your employer. If you're not able to fully maximize that plan itself, you should be doing that as well. You should be saving into your taxable accounts. And then once you've all sort of saved for yourself and paid yourself first, then what you're left with is all of your discretionary money, right? How do you go out and have fun? How do you do the rest of the things that you want to do? But once you've taken care of that savings first and you've kind of paid yourself first, it really takes a lot of the stress out of investing and saving for the future.
We only got a couple seconds left here. If we're talking about going out, let's end on a fun note. If we're talking about going out having fun, what does a smart spend, if you're going out having fun and perhaps purchasing something, a product or a good, what does a smart spend look like versus something that, hey, you probably shouldn't put your money towards that?
Yeah, you know, again, a really good rule of thumb is that if you don't have the cash on hand to pay for it, it doesn't mean you shouldn't use credit cards and it doesn't mean you can't use debt. But if you don't have the cash on hand to pay for it, you really might want to think twice about whether it's something you can afford right now or whether it's something you should save for in the future.
Very sound advice. Martin Seamus, who is the Janney Montgomery Scott Vice President and Head of Wealth Planning. Thanks so much for taking the time here. Making the trip up from the great state of Pennsylvania. I'm a little biased, folks. I'm sorry. I'm from there. Anyway, much more on wealth after the break. You're watching Yahoo Finance. Got some economic data for you folks. New home construction falling in March, which means less inventory for houses and higher prices for what's available. And if you can't afford a home, it might not be entirely your fault. People aren't moving because it's so expensive to move out of their current homes, thanks to high interest rates. So to break down the math here, and make the math, we've got Yahoo Finance reporter Danny Merriman. That's what they say, right?
Well, the math ain't mathin' right now, Brad.
Okay.
So it's really not financially smart right now to sell your home. And there's new research out from Intercontinental Exchange, a data service that really drives this point home. On average, buyers who are looking to move into a pricier home pay about $400 more for this home. But now, buyers who are looking for these pricier homes or moving into these pricier homes are going to have to pay about $1,300 more. Now, that's really not attractive and not really convincing homeowners to really say, hey, I want to move right now. And that really is affecting the inventory, the homes that are for sale. And for buyers who did take out a mortgage in 2020 and 2021, either by buying or refinancing their mortgage, well, you know, you're going to have to be paying a lot more, about 132% higher. Your mortgage payment will go up, and that's relatively around $1,700 more for an upgrade on a home. So now what about the equity that you earned on your home? Right. Yes, if you roll that over and you purchase a pricier home, yes, your monthly mortgage payment could go down, but on a percentage basis, it still doesn't pencil out, Brad. One of the key factors from this research is they're really pointing to the fact is lower mortgage rates will really drive a lot more inventory, could push those prices down, and obviously more people will be flooded into the housing market. But again, mortgage rates right now, if we look at them, they're hovering around 7.5%, and Redfin reported that 75% of homeowners have a mortgage rate below 5%. But the outlook really on mortgage rates doesn't look good, as we've seen these inflation numbers higher than expected. And home prices is still another factor in all of this equation. Inventory is down 40% from pre-pandemic levels.
Yeah, it's really remarkable, and a larger question of what levers the Fed does have to pull that can really eradicate some of the issues in the stickier part of the inflation picture right now, shelter and energy. Shelter, of course, being the one in focus for this conversation. Danny, thanks so much for taking the time. Also, everyone, I want to quickly take a look at Bank of America. It's up so far today, but recovering from yesterday when shares fell 3%. The bank reported setting aside more money to cover souring loans from consumers struggling to pay on time. And according to a new survey by the National Foundation for Credit Counseling, 31% of Americans do not pay their bills on time, while 32% feel like they're just getting by financially. So to help dive into some of these numbers is Bruce McClary, who's the National Foundation for Credit Counseling's Senior Vice President of Communications. Bruce, thanks so much for taking the time here with us today. First and foremost, you take a look into the survey results and the findings here. What was most striking to you, and does it seem like consumers, people who feel behind the eight ball, are charting a pathway to more financial clarity, perhaps?
Well, yeah, thanks, Brad. It's appreciate being on the program, being able to dive into these details about our survey, because I think there's some things that are really troubling about what we found in the survey. I think one of the things that struck me most significantly is how many people are carrying high interest rate credit card debt from month to month, and how difficult it is for them to pay off that debt and pay down that debt as they have to deal with it. And also on the flip side of that, how few Americans are putting anything aside into retirement savings. We found that about a third of Americans not only aren't contributing actively to retirement savings, but have no retirement savings to speak of. And so when you couple that debt burden with the lack of savings, it's no wonder that about a third of Americans feel that they're just stuck financially and they're not getting ahead. And some of the good news that they hear about the economy isn't filtering down to them. So that's deeply troubling to see that so many people are burdened with debt. And I would add one more thing, that of the people who are carrying the high interest rate debt from month to month, the most well-represented group in that response area are people who are 45 to 54 years old. And that's the last group you want. to have trouble clearing out high interest rate debt, especially when they're on the runway to retirement.
Yeah, certainly. You know, it was interesting within the survey as well, identifying 2 in 5, 40% of Americans who carry an average of $5,000 in credit card debt on a monthly basis, and 1 in 4 of them saying that that's an increase over the last year. What notably are you witnessing on the credit card side and the amount of people that are tapping to credit where cash just isn't cutting it?
Yeah, and I think there's an increased level of comfort in using available credit to gap fill where there is no money in the budget. We found that 1 in 3 Americans are comfortable maxing out their credit despite any potential economic downturn. And then about 1 in 5 feel that if they're going to be in debt, the amount they owe doesn't even matter. So I think people are just deciding, well, if I don't have the money, I need to buy these things that are important. I'm going to use whatever available credit I have, and then I'm going to deal with the consequences later. But I think there's another layer to this story that's very important too, because I think people are struggling to get the things that are the necessities in life because inflation is still a very significant issue, and your money just doesn't go as far as it used to. And people who go grocery shopping can only buy about 2/3 of the items they could have bought with the same amount of money 3 years ago. So they have to make some very difficult choices. And rather than giving up those items, some people are just using credit to pay for the necessities on a daily basis.
Okay, so what's the fix here, Bruce? I mean, where can people who are watching right now put some type of plan that's into action there where it stops the cash bleed, if you will, in the near term and perhaps gets them back on the pathway towards reestablishing better credit than current?
Yeah, I think the first thing you need to do is take a good, close look at your circumstances. And if you really are just treading water, you're not making any progress paying down your debt, and you're having to lean on your available credit more than you should, try to find ways to stop the spending. Look for areas in your budget where you can find room to make cuts, to put extra money towards your credit card debt to pay it down faster. Look for more affordable ways to manage your debt. If you have a high credit score, you can qualify for lower interest rates, balance transfers. But if you're in a tough position, you're already sliding past due, reach out and get help. Nonprofit credit counseling agencies are out there to help you make decisions and move forward and tackle some of those challenges that you're having. But you shouldn't feel that you have to go through this alone, and you shouldn't let things slide so far behind that you're getting calls from debt collectors and having somebody pull your car out of the driveway with a tow truck.
If you do get a call from a debt collector, what is the first thing that you should be discussing with them, Bruce?
Well, you should be honest about your circumstances. I used to be a debt collector, by the way. You should be honest about your circumstances, and you should be realistic about what you're offering the debt collection agency. I mean, don't make a commitment just to get out off the phone and to have them stop talking to you. Just be realistic about it, and try to work out an arrangement where you can make installment payments, portion it out to get back on track. Depending on how far past due you are, there may be options you're not aware of to amicably resolve the situation and get things back on track. But don't make promises you can't keep when you're talking to a debt collector. That's very consequential, and it could hurt you later on.
All right, some valuable insights, and I didn't know that about you, Bruce, so appreciate you disclosing and sharing that with us. Bruce McClary, National Foundation for Credit Counseling, Senior Vice President of Communications. Bruce, thanks so much for taking the time.
Thanks, Brad.
Certainly. Coming up, interest rates are at all-time highs. Well, yeah. What ETFs should you have in your portfolio to hedge against tight monetary policy? We'll dive into that next. All-time highs relative to previous standards. Anyways, we got much more on that. Plus, our very own Pros Supermanian and Rick Newman got to ride around in a Kia. We get to that on the other side of the break. Fed Chair Jerome Powell dialing back expectations of rate cuts this year, saying there's been a lack of further progress on returning to the central bank's 2% inflation goal. 80% of traders think the central bank will hold rates steady in June, and not even half of traders see a rate cut in July. So how can you hedge against some of that uncertainty? For more on this, we've got Christy Akulian, who is the BlackRock head of iShares Investment Strategy Americas, part of our ETF report brought to you by Invesco QQQ. Christy, great to see you. Thanks so much for taking the time here. So a lot of traders trying to really get ahead of what the Fed may do, and not trying to fight the Fed, but trying to anticipate them. What is the best way that, and the context that people need to keep in mind as they are trying to put forth an anticipatory measure around the Fed?
Yeah, and thanks for having me, Brad. It's great to be on. I think that you highlighted the macro picture, or at least part of it, perfectly, right? I think where we are right now is that we very much expect inflation and interest rates to be higher than expected. But I think the other side of that coin is that we also see growth a lot stronger and higher than expected. So it's not unambiguously good or bad. I think it's just a little bit more complicated. So in particular, ways that investors can think about positioning for these higher interest rates or really taking advantage of them and this higher for even longer situation that we think we're going to see. We see some opportunities within fixed income. So BINC is our BlackRock income ETF. I think that is an awesome way that investors can really think about portfolio positioning for these higher rates. It's within an active strategy. And you can think of these as sort of the plus components of fixed income. So this isn't just the basic things that you get. It's a little bit more exotic, a little bit harder to access on your own. But what you're really doing is entrusting a proven portfolio manager here to actually go out and source and identify some of those sources of income that are really unique to this opportunity where the Fed keeps interest rates for a bit higher for a bit longer.
So that you're describing a restrictive territory perhaps here for rates. With that in mind, how do we kind of continue to evaluate the economy reading after reading when we hear about consumer resilience on one end, spending continuing to move forward, and then additionally on the other side, you've got on the other end of the Fed's dual mandate, they're going to be looking at employment, and employment readings continue to come in pretty hot right now.
Yeah, I definitely think it's a mixed picture, right? So again, this is not unambiguously good or bad, because to your point, even though inflation and interest rates are higher, what we've seen from the job market is incredible strength. So we're not actually seeing, the precursors of a recession like a lot of people thought that we would coming into this year. I think that's a great thing for the economy, and the strength of the economy has really surprised to the upside. I think that can continue to mean that stocks can continue to pull higher from here too. So I think that's a very important consideration. It's almost the flip side, if you will, of higher inflation and higher interest rates. The silver lining is that that's coming from a really strong economy. So I think that there are ways that investors can invest in that outside of just fixed income and taking advantage of those higher yields, but really within the equity market and within the stock portfolios of investors that we're speaking to, we see the most opportunity in the highest quality parts of the market. So the more uncertainty there tends to be in the macro environment, the more investors gravitate and should gravitate towards quality. And luckily, we have kind of the perfect ticker for that, too, is QUAL. And I think that's a really important thing that people should be considering. And it's a place that people should consider allocating to right now, given the kind of mix of the mixed picture that we have from the macro environment.
Christy, while we have you, we've got to talk about the major event that is international elections this year as well, with over half of people in the world population expecting to participate in some type of voting process or political election, one way or another. That spells some potential uncertainty as well for people's portfolios. How are you evaluating that?
Yeah, it's a hugely important point, right? That's impacting people's day-to-day lives. It's also impacting the market. A big part of how it's impacting the market is really just uncertainty. And we know markets hate uncertainty. So, I talked about it already, but I think that's just another path that leads back to preferring higher quality companies within your portfolio. So again, within US stock markets, I think that what that leads to is thinking about something like QUAL. Outside of the US, though, I think there's a lot of focus right now on identifying not only the regions, but even the specific countries that are doing well in the global economy and that maybe are benefiting from some tailwinds that even the US isn't. So one of the conversations that we've been having a lot, and one of our highest areas for conviction outside of the U.S. is actually Japan. And I know we've spoken about this a little bit too, but just there's a lot of macroeconomic and tailwinds around Japan right now that lead it to be a pretty interesting opportunity. And I think that especially for U.S. investors who are maybe looking for ways to diversify away from just tech or the Magnificent Seven, something like EWJ and their portfolio, the MSCI Japan fund that we have, can be a really great way to do so. So stay invested, but just get a lot more granular based upon the kind of the amount of diverging policies and elections and macro that we're seeing change over the course of the year and around the world too.
Christy, I kind of expected you to say something about India as well. I mean, Apple going into India a little bit further here. They've got a retail location now, looking at really ramping up or at least scaling up some of their operations. Their Tesla as well, scouting for some showroom locations. I mean, is there a thread that you're kind of pulling together on how some of these multinationals are looking at that region?
Absolutely. And if we're talking about Japan in the developed market space, it's the exact same conversation in emerging markets where investors do want to get a lot more specific. And India is benefiting. It sort of sits at the nexus of multiple what we call mega forces. So I think one is improving demographics. So India has a young labor force, which should lead to greater GDP growth in the future. And the other side of that, and something that you touched on here too, is something that I think we've heard a lot about in terms of rhetoric, just of friendshoring or of reshoring, and really just companies optimizing supply chains for things other than just price. And I think India benefits from that a lot. So companies that may be moving, parts of their supply chain there, parts of their development there, I think that being at the center of those two mega forces puts a lot of tailwinds behind India. We've been having a lot of conversations about INDA. The India ETF is a great way to access that sort of complex market for outsiders. And so I think that that's something, that it's not just a tactical trade. It's not something that we would say is just something to hold for this year. We think that that actually has room to run over the next decade plus as a lot of those trends continue to kind of unfold.
Christy, always a pleasure to speak with you and get some of your insights. Christy Akulian, who is the BlackRock head of iShares Investment Strategy. Thank you so much.
Thanks for having me.
Certainly. Well, everyone, looking to make the transition to an EV, but need enough seats for the whole family? Big question for a lot of households out there. Kia's all-electric 3-row EV9 helped push EV sales up in March, and 151%. My gosh, my eyes almost popped out of my head for a hot second there, from the prior year at least. Kia launched the vehicle late last year, we should note. And Yahoo Finance's very own Pras Subramanian and Rick Newman got to try it out. I mean, I love hearing about you guys' ride-alongs that you do here. What did you find out from this model?
Pras is a bad driver always. I'm never comfortable when he's in the driver's seat. I'm sorry, you had something to say.
Well, first of all, Rick, because it was a 3-row, a large SUV, Rick started off the shoot in the back seat, thinking that that'd be the place for him to be when we started the shoot, so we couldn't even see him.
But I can't relax when Pras is at the wheel.
But anyway, back to the kind of the space of this thing, Rick, the reason why we kind of tested is because this is the first 3-row sort of mainstream EV SUV that's in America really offered right now. That's not $120,000. This car starts at around mid-50s for the baseline trim. Of course, ours was souped up, Rick, with the relaxation package that costs extra $2,000.
That's what I was testing out in the back seat.
$75K range. So expensive, but not that crazy when a Tahoe costs that kind of money too.
I mean, we like EVs, I think, right? I mean, they are fun to drive. We like the concept. I'm not ready to buy one personally because I only have one car and I don't want to have to deal with range, issues when I'm driving to Vermont.
What was the range on this one? Do you remember?
It's about 300.
Yeah. I'd say the EPA is a little bit less, but we had 300 when we picked up the car with full charge. So that's what Kia was saying. The vehicle was saying, I have 300 miles of charge. Just don't watch out for cold weather and things like that. But
see, that's what I don't want to have to think about. But I think there's a problem in terms of making a purchase decision for a car like this, because I think it's hard to know what's the right price for an EV. I mean, we talk about this all the time when we're driving these things. I mean, we're driving this at $75,000. This one does not qualify for the $7,500 tax rebate, correct?
Well, it's not made in America, so
It's not made
or
here.
North America.
So you'd have to lease it
Yes.
to get the tax break.
Yes.
And there's all this news. There's now this glut of EVs. Supposedly, automakers have made too many of them, so there are discounts. Tesla has been discounting. Others have been discounting behind Tesla. So my problem is, what is the right price to pay for an EV? And maybe you think 50 grand, 55 for something this big that can haul the whole family is a bargain. I'm not so sure.
I guess it depends upon the amount of use, though, that you're going to get out of it as well, and that could come back to the range considerations.
I mean, it is a family hauler, and if you're going to be taking the kids,
it fits seven comfortably.
Yeah, easily. You're taking it around to the soccer practices, grocery shopping. You're not potentially. I mean, you could take it on a road trip if you can plan out your sort of charger sort of path. But I guess the big picture is, I thought many people thought when this car came out that it'd be selling like hotcakes. Americans want a 3-row car, an EV, great. But it turns out even this car is being discounted on the lots, surprisingly. Kia, like you said, had pretty strong sales for EVs compared to last year, but they're still making too many, and there's not enough buyers just quite yet.
So, so is that? I think that is because we've sort of ceilinged out in terms of the people who are willing to be the early adopters. So something in favor of this huge hauler like this that's electric is it's actually ideal for running around because if you have this car in a gas version, you're going to get 10 miles per gallon, right? 12 if you're lucky, or maybe 15 in a Highlander or something. I mean, this is ideal for hauling around where you would otherwise be getting terrible mileage, because that's what EVs are great at.
Yeah.
You bring it home and you charge it overnight. You never have to hit a gas station.
Right. And just real quick, I think the thing looks pretty good.
Yeah, it does.
And the inside was
Good
like
execution.
luxury
Yeah.
level. I thought I was in a Range Rover.
Yeah.
That's how nice it is. So this is a Kia. So
all right.
Yeah.
We'll see.
We got to go, but grades on a scale of 10. Do you guys give us grades typically?
We need to come up with a system, but you go ahead.
I mean, I would give this a
crossheads or rickheads.
I would give this a 7.
Yeah. 7 rickheads out of 10.
And I'm not going higher because it doesn't qualify for the tax rebate and the cost questions.
And Kia does build stuff in America. If they brought this over to manufacturing, maybe then it's a better
which they
value.
could.
But I think a 7 is a strong choice.
7 Pross and rickheads. Done deal. Thanks so much, guys. Appreciate it. Well, gas prices, as we were talking about a little bit there, smidge, gas prices are up 20 cents from a month ago at $3.66 per gallon, according to AAA. With U.S. crude still sitting around $84 per barrel, how high could gas prices go in the next few weeks? Yahoo Finance senior reporter Inez Ferre is here with more. Hey, Inez.
Hey, Brad. Well, in the Northeast, around the New England area, you can expect to see prices going higher. That is because that summer blend that we've been talking about, which makes gasoline prices more expensive, and some states have already switched to that summer blend, that will be happening. That transition is going to be happening in states like New York, like New Jersey, in the New England area. So you can expect prices to go up to almost $4 per gallon once that whole conversion takes place. On a national average, some analysts are calling for prices to go up to around $3.75 per gallon, or even a little higher than that, and then recede a big back. So that more expensive summer blend is making gas prices more expensive. Of course, oil prices, which have rallied this year, that has driven gasoline prices higher. You had gasoline going up about from $78 to $85 in about a month's time. That accounts for about 17 cents of that gasoline hike that we've seen in the last month or so. As far as California is concerned, we saw gasoline prices there go a lot higher in recent weeks, and part of that has to do with refinery maintenance that have been planned, that weren't planned as well. So that really shot up prices in the California area. Look, analysts are saying that if gasoline prices, Brad, get too high, if they do go much above $3.75 for the national average, then the administration could decide also to release some more SPR. This is an election year, remember. So if gasoline prices really get too high, if oil prices get too high, then we could see a release of that. But then other analysts are saying, look, you are going to see OPEC coming in with more spare capacity. They don't want to lose market share when it comes to oil. So you could see some levers being pulled this year.
All right, excellent synopsis and what it means for folks out there watching, especially as they're keeping close tabs on the prices at the pump. Inez, appreciate it.
Thank you.
Coming up, Adidas could be bouncing back. We're going to dive into how next. This next story might knock your shoes off. Adidas raising its profit target for the year as the company gets a boost from strong demand for its Samba sneakers and the remaining sales of its Yeezy brand. Now, will this be enough to get Adidas or Adidas back on the map amid growing innovation struggles for the footwear brands more largely here and considerations there? Joining me now in studio for this discussion, we've got Yahoo Finance's Brooke DePalma. Brooke, let's just start on the updated outlook here. What did Adidas say?
Yeah, absolutely. So based upon this better than expected performance in Q1, the company is now increasing its full year guidance for 2024. They now expect revenue to increase at a mid to high single digit rate. And they also, as you noted before, expect operating profit to come in higher as well, around $745 million. That's as compared to what they previously thought was going to be up, or rather come in at $532 million. Now, this does come 1 month after the company posted its first loss in 30 years. And so Wall Street really liking this updated guidance as the company really sets out to reverse these declining sales. And those two factors that are boosting the outlook for the retailer include that selling off the remaining Yeezy inventory, something they've been looking to do for the past 2 years. And in addition to that, this retro sneaker trend, consumers really leaning in to this idea of the Samba the Campus and the Gazelle, as you can see on the screen here. They really like this idea of these retro sneakers coming back, consumers buying them up.
The Samba was last hot when I was in 3rd grade, Brooke, so what's old is new again, apparently, for some of the the lesser millennials out there, or I guess,
Gen Z, millennials,
looking
all the
to
young
get
folks.
into what was hot when we came up anyway, but that's whatever. Also, on the Yeezy front, you mentioned that they're not expecting to see further profit contribution during the remainder of the year. They noted that. I also got to wonder how well Anthony Edwards and some of the basketball lineup is doing for them. It's been a massive year for him as well on the NBA side.
Yeah, in addition to that, you have to take into consideration that the Olympics are happening this year. We're going to see Nike, Puma, and Adidas all coming in really hot, really looking to market and sell based upon, what they're going to front during this summer in Paris. And in addition to that, we're just seeing this trend of consumers wanting to be comfy. I just did a piece for Yahoo Finance last week on this. Really, people leaning into those New Balances, people even leaning into Uggs, which is doing well for Decker brands, and Crocs. And this idea of comfort, performance, but also some people thinking that this looks so trendy and that it's just, on point.
I myself am in the market for comfort. I took a look at some clogs from Birkenstocks. So we'll see if they're comfortable, but I heard they're good for you anyway. Brooke, thanks so much. Appreciate it. All right, everyone, switching gears for a hot second here as we end the show. Some breaking news. Alaska Airlines saying its ground stop has been lifted, according to reports. This comes after it was halted by the U.S. Federal Aviation Administration today. The FAA saying, quote, all Alaska mainline and subcarrier flights ground stopped. And the FAA also saying that Alaska Airlines asked the regulator to pause its mainline departures nationwide. Take a look at shares of Alaska Airlines today. Ticker symbol ALK. It's up right now by about 3% here. Of course, a lot of movement anytime you get a decision that comes down from the FAA. We'll see what further comes more and moves. Ticker symbol ALK as we're seeing it up right now. Let's do a final check of the markets. As of this point in time, the Dow, the S&P 500, and the Nasdaq, you've got them in negative territory, fractionally as it may be, declines across the board for the 3 major U.S. averages. That's it for now here on Wealth on Yahoo Finance. I'm Brad Smith. Thanks so much for watching.